All right. Well, hey, good morning, everybody. Happy Saturday. Welcome to our Note Weekend training class. Basically, we call it kind of Note Investing 101, to kind of help you getting started as a note investor. My name is Scott Carson. I've been an active note investor. It's hard to believe for almost 20 years, a real estate investor for definitely over 20, and excited to teach this about 3.5 hour class, kind of the getting started, how to dip your toes in the water, some of the basics when it comes to note investing. We'll talk about how we find these deals, how we raise capital for them, and then also the different exit strategies when it goes into making money. We'll also talk about some of the vendors that you need, the team that surrounds you. But I'm committed to helping you take your business to the next level. And if you're, whether, doesn't matter what kind of experience you have in real estate. I mean, that's great. If you're a realtor, a mortgage broker, or you've flipped a lot of properties, or you've got a ton of rental properties, that's great. Or if you've wholesaled a bunch or looking to start, that's all great. But note investing is a bit different from all those niches. It's definitely a niche within a niche. When it comes to note investing, most people think about owner financing, selling or buying on terms, and then being in that deal for 5 to 30 years. And that's not always the case. Yes, it'd be great if we bought notes that people paid on time for 30 years, but a lot of times people don't pay. So I focus on the niche of non-performing notes for the most part and buying from institutional buyers about 95 to 96% of the time. Yes, we'll talk briefly about owner finance notes. We're not going to get into how to structure those deals. That's not what we're here to teach today. We're here to dive into the world of non-performing notes for the most part, because that's really what my niche, and I think it's the most profitable niche out there, especially with the market being where it's at and the opportunities. Now, um, I uh, I'm a big believer there are no dumb questions. If you have a question, it's important to ask it. But I'm gonna tell you, please, as you're watching this or as you're catching the replay, you can ask your question anytime in the chat role, whether it's on YouTube or stuff like that, and we'll answer it. But if you're here live on Zoom, please keep your questions relevant until we get to that segment of what we're discussing. There'll be a few breaks throughout. We're going to try to run through this pretty relatively quickly. We'll take a couple bio breaks after a couple sessions so you can get up, get a fresh cup of coffee, use the facilities. We'll take a short break about midday so you can grab a quick bite to eat. But we're going to run through this pretty rapidly, and we will live stream it. It will be up on YouTube so you can go back and watch it again. And yes, we'll talk about our next steps there for you, about our classes and our monthly membership and coaching a little bit at the end. This is not meant to be a pitch fest at all. We're going to go through basically a good 3 4 hours of content here for you so that you can walk away from watching this video and having a much better understanding of note investing when it comes to buying institutional debt, buying non-performing notes, and the opportunities that come with that. All right. So let's dive into that. And it says, here in a second. Like I said, guys, Scott Carson, I've been buying notes for almost 20 years, bought thousands of deals. We've taught thousands of other note investors how to buy their first note. One of the things I am most proud of, okay, my deals are great. Bought over $1 billion of debt. Whoopee freaking doodah. I'm proud of the fact that we have helped really, it changed the way many real estate investors approach notes and taught them how to capitalize them to buy this stuff, work it out, and get amazing returns and really change the path of perspective that they're on into doing something that they really enjoy. I don't know you guys, but I've been, as when you've been an investor for a while and you're getting to do one thing, sometimes it gets kind of like old. You get tired of dealing with toilet sins and trash. You get tired of rehabbing properties and dealing with contractors. Trust me, been there. The one great thing I love about notes, though, is I don't get tired of it. It's such a vendor driven with servicing companies and attorneys and stuff like that, that once people get back on track, it is true pretty much a passive return. But if you're buying non-performing, you're going to put some work into it in the front end through your servicing company, through your attorneys, through your working out which way you want that cookie to crumble. But it's really, I say it's the most profitable niche. It's also the sexy side of real estate. Because a lot of real estate investors, they start off wholesaling, trying to wholesale. They get into some light rehabs, heavier rehabs, and they become a lender through either hard money or they end up getting into the note business like, hey, this is so much easier. And I can do this not from my backyard, but I can do it from all across the country. So if you're in California, or what you would buy one asset there, you could buy a block in St. Louis and Michigan, or a dozen assets in Florida. It just varies on what you're doing. So we're going to have some fun here. Like I said, no dumb questions. I'm here to help you take the next step, and what that next step is. Maybe it's sign up for a workshop. Maybe it's to buy your first note. Maybe you're like, maybe I don't want to do that. That's totally A-okay. But you will walk away with here with some nuggets that you can apply to no matter what niche you're in, especially on the raising capital side, as we'll talk about how we connect with investors, how our students have been raising millions of dollars from private investors to fund their note deals. So let's get it started and get rock and rolling, shall we? All right. So there are some things I want you guys to keep in mind. Write down. There's some resources right off the bat. We are very proud of the fact that we are the #1 investor recommended training for note investors. That doesn't come from me. That comes from some of my peers in industry. Very, very proud of the fact, like Bill McCarro from Paper Source. And then if you look at the who's who of different conferences, you'll often see multiple people who have been through our one-on-one coaching or training too that have gone out and done amazing things. So we're really proud of that. Okay. So let's dive into what type of resources are there. Look, we've got a ton of videos on our YouTube channel at weclosenotes.tv. You want to go there and check that out. We also have a Note Nation Facebook group that's pretty good. It's about 1,000+ members. It's good to go in there, network, ask questions. Of course, encourage you to network with each other. If you're not connected with me on LinkedIn, go do so. Send me a follow on LinkedIn. Got 30,000 connections on there. And you'll see me sharing videos and content and breaking down assets for you. And if we've got some time at the end of the day, we'll actually even open up for those that are on here to do a little bit of networking as well for you. I've got a hard stop. I've got to be done basically by 2 to actually go meet a contractor today. We're rehabbing a property for a friend here in town, and got a hard stop for that. Yeah, I don't like to rehab a lot of properties in a lot of cases. I actually prefer to own the paper, but this is an opportunity. It was a note deal turned into an REO. It's a deed in lieu, so it's a pretty good deal, and we'll probably share it later on in a future episode. But anyway, as I said, free sources. We have our Facebook group. Our Note Night in America webinars. Usually on Monday nights, we'll restream a session, a interview, something that's going to add value, a tactic, a tool for you guys to take advantage of. I think this coming Monday night, we're going to be talking about probate leads and resharing that interview from U.S. Leads List. Micah Nichols. We interviewed him earlier this week. It was a really great episode. I think you guys will really enjoy it. Of course, our YouTube channel is the #1 YouTube channel for note investors out there at weclosenotes.tv. Go there, subscribe, and you'll be up to date on everything we publish. And then, of course, we've got talkwithscottcarson.com. That is my booking link to get a slot on my calendar. I'm sorry. So if you go to talkwithscottcarson.com, keep that in mind. That's why we change the name on Zoom here, so you have the ability to schedule a call with me at any given time. All right. Now, if you go to schedule call and there's nothing available, just shoot me a text message. I'm glad to say, let me open up something for you, or schedule time outside of that. But also, we do have our next steps is upcoming here in April. It's our next 3-day class, notebuyingfordummies.com. You can check that out. We're running a special on that. We have a monthly membership for $97 a month that gives you access to some tapes and extra training and coaching calls and stuff like that. And then also we have a one-on-one coaching program, which is the best in the industry, that really helps you buy your first note, your first 20 notes, whatever your goals are. Get rocking on. So I always like to ask, what do you want to accomplish? Why are you here on a Saturday morning or to watch the replay? Why are you here? We've all got things that we want to accomplish. Are you looking for cash flow? Are you looking for assets that you can buy? Are you looking to boost your income or your retirement? Like, hey, I need to come up with retirement. Or, hey, JOB is not going to give me enough. What is it? Are you just tired of being tired and chasing the next strategy? Like a lot of people at different real estate clubs, they go from 1 week to the next week or 1 month to month. There's always some new strategy they try to dive into, but they don't seem to be able to have any momentum with it. All right. Are you looking to put money to work? You're like, Scott, I came into some money. I've got a 401k I need to put to work. I've got a self-directed IRA that's just sitting on the side. What are you looking to accomplish today? Whatever your why is, I'll tell you that right now, we can help. Okay. Now, I know that sounds maybe a little arrogant, but it true is. Maybe it's not something that we can help you with, but we can put you in the right direction. We can actually put you with somebody. If it's through us, great. If it's not, we're glad to help you take that next step and help you accomplish your why, whatever that might be. Okay. And there is no wrong answer to this question. We have some people that, hey, I'm just looking for notes as a hobby. I want to buy 1 or 2 notes a month, maybe. I've got other folks like, no, I want to buy 20 notes a month so I can replace my income from the job that I hate or the career that I hate. Whatever it is, hey, don't stress about it. We can help you do it. All right. We can definitely help you take your business to the next level. Okay. All right. Let me do one thing here. All right, everybody, let's dive into the different types of notes that are available out there in today's market for you. Now, you're going to hear me talk about institutional versus non-institutional debt. Okay. Now, what does that mean? Well, institutional debt is notes, mortgages that have been written by a lending institution, a bank, a hedge fund, something like that. Non-institutional debt is your owner finance notes, your contract for deeds from an individual, your land contracts from somebody. And you'll end up buying a lot of both of these, okay? But they kind of break down into variety things. You have residential first liens that are performing. You can buy performing notes. You're not necessarily going to buy a performing note from a bank, but you can buy a performing note from an individual like me. Maybe I have a list of notes that have been performing. I'm looking to sell off and recapitalize my money. We've got a portfolio for sale right now from one of our coaching students who's looking to recapitalize, is looking to sell some of the notes that were once non-performing that have now been reperforming for a couple of years. You've got non-performing stuff. That's where non-performing means the borrower hasn't paid in at least 90 days or longer. It's in default. And you can buy a lot of that stuff. There is plenty of non-performing stuff out there. Don't let me tell you there's not. The way we show you how to find deals and how to market, you'll find plenty of non-performing notes for you. And the great thing about non-performing is you're usually going to get those from at a bigger discount. Now, some banks aren't selling stuff at a discount yet, and that's okay. Move on to the next. Okay. Now, there are residential second liens or junior liens you can also buy that are performing or non-performing. I don't focus on this niche. It's a much riskier niche behind a non-performing first. Never ever want to buy a second behind a first, especially if it's non-performing. Now, if you can get it cheap enough and there's enough equity in the property that over encumbers the debt, or where the value is higher than the debt, the combined loan to value, okay, that's not a bad position, provided you can buy it at a price it's cheap enough. But I don't focus on the second liens. A lot of people focus on second liens because they were cheaper. Used to be able to buy a lot of second, junior liens at pennies on the dollar. That's not the case anymore. And I would rather, if you're going to pay the same type of discount for a first versus a second, you might as well buy first because you're in the first lien position. Okay. Don't care what the person's credit score is, whereas in a second lien, you got to make sure that they're paying on time so you don't get wiped out from the first lien foreclosure. But plenty of commercial liens out there. Yes, you can buy performing stuff, but plenty of non-performing commercial debt out there that you can pick up as well too. We're not going to dive in so much of that because each asset class with its self-storage is different from multifamily. Multifamily is different from institutional, from RV parks. We'll talk about some different ways you can find that stuff, right? How to use things like the foreclosure list, the RODI list, and stuff like that to find distressed commercial debt. But we're not going to do a deeper dive into the due diligence side of that. It's a little bit different, okay? Of course, you can buy owner finance notes that are performing or non-performing. We're not going to target those for the most part. I take a different approach. A lot of people that teach, go out and find owner finance notes, they're going to teach you, go buy a list of leads and do a direct mail campaign out to these people or try to call them. That's a waste of time, a waste of money, in my opinion. Can you find something? Yes. People call you? Yes. But they're not going to usually give you the bigger discounts. Yeah, you may find 1 in 20, 1 in 40, 1 in 50. But that's not a very effective use of your time or energy or money, too. I prefer to target institutional debt because banks and lenders will send me lists of notes that I can cherry pick over and over and over again and turn the non-performing into performing. Or I can buy the non-performing and then either finish the foreclosure, loan modification, or whatever it might be, to make a good return. Now, I talk about posting that I buy notes on LinkedIn and Facebook and stuff like that, and we get plenty of owner finance sellers to call us that way, but we don't spend a huge amount of money or kill a ton of Amazon trees to make it happen. It's the 21st century, it's 2025. It's time you start marketing like it's 2025 versus those that teach the old way of doing things. And it just doesn't work as well, okay? You also hear us talk about contract for deeds. This is a non-institutional debt. You did have some funds create a lot of contract for deeds where they basically owner finance the property to really a non-qualified buyer back in the day. These were when there's a ton of REOs out there that were below $100,000 in value. Companies like Rock Top and Harbor Portfolio bought thousands of these small balance REOs from Fannie and Freddie Mae back in the day. So they put mortgages on them that would take longer to foreclose. In a lot of states, if you put a contract for deed on a property, it's treated as a tenant relationship versus a lender or a borrower. So as a tenant relationship, you can also evict a lot faster than foreclose. Also, in some states, if you're evicting, it's much faster to evict on a contract for deed versus foreclose on a mortgage, where there may be a redemption period. Like in Alabama, I'd rather buy contract for deeds all day long versus mortgages, because you can evict quickly in Alabama, versus if it's a mortgage, you've got a 1-year redemption period. So there's a variety of things to see. Don't be so scared of contract for deeds. There's plenty of opportunity out there. It's a non-institutional debt that I actually like in a lot of cases, and we'll buy a bunch of those. Occasionally you see lease options where somebody has rented a property with a lease option to buy. While there is that kind of lending relationship there, it's not enforced yet as an option. I don't focus on these. There are sometimes you'll see people who have put together a portfolio with lease options, and that's great. I just don't value those the same as I would a traditional borrower or a contract for deed borrower as well out there. So now, where should you focus? That's the $1 million question. Where should you focus? Should you focus on cash flow or the property? I'll tell you right now, focus on cash flow. If you focus on using notes to try to find property, like I'll give you an example. We've got a few folks here from California. I don't buy anything in California. No offense. If you're looking to buy in California, yeah, you can find stuff in California, but it's usually not at a significant discount. Okay. Also, because people overpay for California stuff all the time. It's stupid, and the yields are not good. I'm not going to do something for a 3 or 4% yield. I want to make a 12% yield or greater. So what you can buy for one note in LA, unless you're buying at a significant discount where you're going to see a 7-figure profit in a lot of cases, it makes more sense for you to buy in a pool in Michigan or Ohio. When you look at how your money's leveraged and the cash flow that can come in from 20 notes versus one note, your risk goes down a lot in a lot of cases. Now, like I live in Austin, Texas. Austin is a very popular area, hot market. If I were to just focus on buying notes so that I could acquire the property here in Austin, I would have gone broke a long time ago. All right. But I focus outside of my own state into the most popular states to buy in, that have inventory that I can buy, that I can convert to cash flow. Or if I do have to foreclose, it comes into a pretty good deal where it's more buyers for that stuff. So focus on the cash flow first versus the property. Should you focus on your return on investment? Well, yeah, of course, that's always important, but you also have to focus on your return on time. All right. Most notes are not going to be a 90-day deal in and out. It's going to be probably a 6 to 12-month process, but it's going to pay big. When you look at, you can buy a note at 50 cents on the dollar and either get the bar back on track in 90 days, so it's becoming a 12 or 20% cash flow. That's a pretty good return on investment, right? Or if you have to foreclose, it's going to be something that you're buying that property at a much cheaper price technically than you would buying as an REO. Obviously, state inventory always has a very important aspect of it. You're going to see more stuff, in, like I say, Michigan, Indiana, Ohio. Those are my 3 favorite states for looking at stuff. You also have the Carolinas, North Carolina, South Carolina. You'll see quite a bit of stuff in Florida, but I'm avoiding Florida right now, insurance and the HOA stuff like that. So, and your inventory levels are always going to change some. Now, if I see something in Miami and I can buy it cheap enough, and I've got friends down there that are looking for that, and they know the issues, great. I'll broker the deal to them, or I'll flip it to them. But I mean, I've bought hundreds of properties down in Florida over the years by buying the notes. Your markets are going to change. It just is what it is. Okay. Pricing obviously has something to do with it. Okay. Miami of Ohio should be cheaper than Miami, Florida. Okay. Austin, Minnesota is going to be cheaper than Austin, Texas. All right. So know your pricing, and it also depends too on how much equity a borrower has. If there's negative equity, meaning they're upside down, there is no equity, pricing is going to change some as well too. And time is also important. As we talked about earlier, what's your why? Is this just going to be a side hobby of 5 to 10 hours a week? And that's completely fine. You can put in 5 to 10 hours a week and make plenty of deals happen. If you're looking for 20 to 40, you can definitely do that too. If you got a full-time job and you only have a couple hours a week, then you probably want to focus on the passive side, either of lending or maybe buying reperforming notes that are performing and give you a double-digit return in your retirement accounts. That is up to you to decide. I can't decide that for you, right? But I will guide you through it. That's why I always encourage you guys, if you're watching this book a call with me, talk with scottcarson.com. I'm glad to kind of walk you through things. I'm going to tell you though, if you call me and you haven't watched this all the way through, I'm going to tell you go back and watch this all the way through. Don't waste my time by asking questions that can be answered here. All right. Because there's a lot of great stuff on here. One of the great things that we have put together over the years is a presentation on how to make six figures in your next 12 months. So if you go and check out this website, bit.ly/100K in 22. Yes, it's 22. We've got a new one in 2025. I haven't changed the link on it yet. But go to our YouTube channel, Six Figures in 2025. It's a great plan of action for you to acquire, especially those that are doing this on a part-time basis, how to acquire one note per month. That's bringing in $300, $400 a month that you're not responsible for the property management. And over 12, 24 months, if you're buying one note at that rate a month, you'll bring in six figures in your year, 10 grand a month in cash flow. Okay. All right. And that's just giving you a ballpark of stuff. Now, I'm always amazed when I talk to landlords and I ask them what kind of cash flow they're seeing. They're saying, oh, 200, 100, $300 a month. I'm like, that's not worth my time, ladies and gentlemen. That's one, removing your profit for the month. That's one AC service check. Somebody coming out, a plumber to fix something. That's going to ruin your cash flow for the month. Not worth it. Okay. Nobody calls the bank when the plumbing gets clogged. Nobody calls the bank when the air conditioner stops working. The bar is responsible for that. So it takes a lot of the headache and the minutes of dealing with toilet sinks and trash outs and termites too along the way for us. So check it out. Okay. Now, one thing that's going to be important too is the states that you buy in, understanding the different foreclosure timeframes. Every state's a little bit different. State foreclosure time frames come down to kind of whether it's a judicial foreclosure or a non-judicial foreclosure. Now, judicial foreclosure is where you've got to go through the court systems to get the legal right to foreclose. Okay. Now, your judicial foreclosures are going to take you probably at least a minimum of 6 months in most cases. Okay. That's not bad. I mean, we buy in plenty of judicial states because we know we're going to get the bar back on track usually faster. They've shown something in our due diligence or in their payment history or, hardship letters to the lender that they want to try to stay in their house. And there's what they're offering. It makes sense for us when we buy that note. Okay. The judicial foreclosures are going to cost you also about, $2,500 or $3,500 or more. Okay. Most of them are east of the Mississippi, although California has a judicial foreclosure process if it's an owner occupant. All right. So, you usually in other states, like you're going to pay less for a note in Ohio because it is a judicial foreclosure versus something, say, in Michigan, which is a non-judicial foreclosure. Okay. Now, non-judicial foreclosures are just like that. You don't have to go to the court systems. The minute that borrower is 90 to 120 days late, you can go file the notice, whether it's the notice of default in some states or just go file it. Like here in Texas, we don't have a notice of default. You just to go hang the notice up. I was down to actually the Williamson County Clerk's office filing a release of lien yesterday, and they've got a billboard where they just a notice, hey, and if you file that notice 21 days prior to the foreclosure auction, which is always the first Tuesday here in Texas, you can foreclose as fast as that, as for as little as like $1,000 to $1,500. Okay, so it's much shorter time frame here in Texas. You can foreclose in 21 days. Once they become 90 days late, like I said, less expensive, but you're going to pay a little higher price point for buying in non-judicial foreclosure states. Texas, Georgia are the fastest because they're under 30 days or less. It's just going to cost a little bit more because it's the speed of capital, and the banks know that. It means you will pay a little bit more, but guess what? If you can foreclose faster in 1 month versus 6 months, the velocity of your capital should be good that you're going to make it up in a higher ROI for you. Okay? Keep that in mind. All right. License requirements. This is the $1 million question people ask me all the time. Well, do I need a license? If I get a license in Maryland, will it work in all the other states? No, it will not. Okay. Do you need a license? Yes or no? Well, it depends on the state that you're buying in. Okay. If you're in most states, if you hire a third-party servicing company like an Ally, a Mass Management, a Land Home, and they're licensed to collect debt in that state where that note is at, then it should cover you okay. Now, there are some exceptions, like I don't buy on the West Coast, California, Washington, Oregon, they want you to have a separate mortgage broker's license. Okay. Maryland just enacted they want you to have a separate mortgage broker's license to buy debt. Illinois wants you to have a separate debt collector's license besides your servicing company, so you got to pay your fee for that. Ohio wants you to have a mortgage broker's license if you're buying seconds. So just talk with your servicing company, talk with somebody like myself. All right. Like I don't have a separate mortgage broker's license. I just have a servicing company who's licensed in those states is where I go in. I'm not buying New York, New Jersey. Some states allow you to self-service. I do not recommend that. That's a bad thing to do. But guess what? You're going to see enough deals in most of the states out there that are going to be valuable for you. And if you are interested in a state and you really are focused on in that state that does require a license, go get your license. It separates you from the crowd in a lot of cases if you want to. Okay. Like in Illinois, to have a separate debt collector's license there, then your servicing company's like $750, and that's good for 2 years. Okay. But that doesn't stop you from buying. In Illinois, you can go and buy. Georgia wants you to have a mortgage broker's license, unless, of course, you're using your self-directed IRA to buy a note. If you're using your self-directed IRA, you're exempt from it. So, or guess what? You go find somebody who has a license that is required in a state, and you partner with them. Okay. It varies, and this is constantly changing. Some require, some don't. Like I said, Maryland just passed a law in the last 30 days. It requires you to have a mortgage broker. Well, I don't buy a lot in Maryland anyway. Okay. Move on. Like I said, talk with your loan servicing company as laws change to make sure you're not violating anything. Okay. Now, what is available in today's market? Reperforming notes. That's a note where somebody has bought it non-performing, boarded with a servicing company, got the bar to come back on track and start making payments on time for at least 6 months. That's considered reperforming. Non-performing notes where somebody hasn't paid in 90 days or longer. That's plenty of that stuff out there available. Contract for deeds. Like I said, where somebody has a property, they don't necessarily want to put a mortgage on it. They're willing to owner finance it on a 30-year mortgage with some down payment at 9.9, 10% interest. These are pretty good ROIs. The borrower is responsible for taxes and insurance. They're borrower for the upkeep of the property, even though it's like a tenant relationship. The only issue is I would avoid Pennsylvania with contract for deeds. The attorney general over there is trying to say that a 9.9% interest is usury and cracking down on people. It's kind of a pain in the ass. So I avoid Pennsylvania for that one thing when it comes for contract for deeds. Non-performing commercial notes, we know there's plenty of multifamily, other properties out there. You're seeing an uptick in commercial foreclosures all across the country, here in Texas as well. That number going to auction every month seems to be going up month by month by month by month. Okay. Old notes on platforms. I joke about this because there are some sales platforms out there you can look at to buy stuff. Low-hanging fruit, but a lot of that stuff is junk. If you're looking for non-performing stuff, you probably won't see a lot of non-performing on platforms. You'll probably see more owner finance stuff, or if it is a non-performing note, it's probably an ugly asset that is trashed out. It may not be worth your time. To find really great non-performing residential notes, you got to learn how to market, and that's not difficult to do. Okay, I don't buy a lot off of platforms just because they get cherry picked over. And if you're looking at an asset, a junked out asset, paying somebody 3 to 5 points in an ugly asset doesn't make any sense to me just because they list on their platform. Okay. You will find plenty of newly originated owner finance notes, people on Facebook, stuff like that. Oh, hey, I just originated this note. I want somebody to buy it from me. If you are going to sell a property, do not owner finance it. Okay. Especially if you're trying to sell it immediately, because you're going to take a discount. That's the great thing is people talk about, oh, you make more money on an owner finance project. Okay, yeah, if you hold the note for 10 years. But if your goal is to get your money back, don't owner finance it and then expect to go around and sell it and get 100%. Newly originated owner finance notes, okay, if you're okay taking a discount and it's an ugly property, you got some situation that's how you got to finance it, okay. But I can't tell you how many times I talk to people each week where they're like, oh, I'm going to take a discount. Like, yeah, you got a low below average interest rate and it's no seasoning on it. You're not going to get 100%. If you're looking at 100%, sell it traditionally and get in, get out. All right. You also have to keep in mind too, when you're getting into the note business and buying debt, you have to take your hat off of being a fix and flipper and put on your banker's hat. Being a banker is different than a fix and flipper. You don't own the property when you buy the note. You have to foreclose to take the property back. And that's one of the biggest mistakes that we see is that people, when they start looking at buying notes, they think they're buying the property. You're not buying the property. Okay? The equity, it's above the legal balance. It doesn't belong to you, all right, until you take that property back. Okay. So quit chasing equity. I see so many people getting, oh, I'm going to overbid. Well, you can't. Why are you bidding full value or above the value of the note? You're not going to end up with a property. It's a hard thing. I've had realtors, people that worked for me for a while, that I'm like, listen, you got to get this through your head. You're not going to get the equity on this deal probably. Now, if you do, great, but that's like down the road. It's not a guarantee. All right. So one of the most important things you can do is, as you start looking at notes, looking at tapes that come in, tapes is basically a spreadsheet that may have 20 to 2,000 notes on it, is you have to start, when you're doing your due diligence, you have to start streamlining your product's focus. Okay. There's a bunch of things. If you're trying out here, you're chasing squirrels and you've got that shiny object syndrome, guess what? You're going to falter. If you're one of these guys or gals that does a jack of all trades, doing everything you go to, this is not the niche for you. Okay. Note investing, if you're trying to do jack of all trades, go do something else, because you're going to, yeah, you could buy a couple notes here and there, but you're not going to have success because you're watering down your message, your time, your marketing, trying to do all these other things. Focus on notes, and I guarantee you'll find plenty of deals if you streamline your process or streamline what you're focusing on. Okay. And streamline the products. Don't go chasing unfinished projects. I like single family homes, 3 bedrooms, 2 baths. I look at duplexes and fourplexes too. The single family homes or condos that I can take down in a non-performing side that's occupied, that gives me more strategies to get the bar back on track. Okay. I'm a note investor. I'm a banker, not a fix and flipper. Okay. That's why I like occupied properties. I get more exit strategies. Vacant properties, you're going to get deed in lieu or foreclosed on. You're not going to get the bar back on track. Okay. Now, I have bought notes where I knew my whole goal was to foreclose on that asset, because that was really going to be the better route for me. I'm not going to mess around with a borrower, because they've just completely for 2 years been playing games. I don't play games. Homie don't play no games, right? Right. But like I said, when you start getting in notes, you're going to be maybe a little overwhelmed. Like, well, where's the deals? Where's the duds? Start focusing on specific things. We'll walk you through a little bit of that later this afternoon. Okay. And your number one strategy when you start calculating the stuff is, what's the cash flow going to be if I get them back on track? If they just start making their minimum payments again, what's that cash flow going to be? Is that a good deal? If I get them making double payments, what's that yield going to be? All right. So there's some things to keep in mind. The second strategy would be taking back the property and doing a fix and flip. All right. I am not a fan of taking back and leasing out, or then taking back and then owner finance the property out or turning it a rental. It's not a good return on investment, and it's going to drive you bonkers. Okay. Any questions before we dive into note sellers and where to start finding some of the stuff? All righty, move on. All right. So one of the biggest questions we often get from people is like, hey, where do you find your deals? How do you find deals? How do you get banks and lenders to send you a variety of deals? Well, that comes out from marketing, and we probably market better than anybody else in the note industry. I'm just going to go ahead and say that. I believe that because if you look at our database, you look at our YouTube channel, you look at our podcast, you look at how our students find deals, because they take in and follow our strategies step by step. You can't half-ass anything here, okay? And you also have to realize that 80% of the deal flow you're going to see is going to come from following up, sending follow-up emails or follow-up phone calls or follow-up messages, following up on bids you made, following up to asset managers that haven't responded the first time. That's where most of the money is made into it. But the different places to find note sellers, you can obviously go and pull a list of banks and start contacting banks, other lending institutions, mortgage companies, mortgage bankers, servicing companies too will often have a designated trader, somebody who's moving assets on behalf of their clients. You can go to different note conferences and conventions. All right, and hang out there. I don't usually pay to go to those things. I usually go and hang out in the lobby, for an hour or two and network with some folks that are there, or hang out in the afternoon after 5. That's where a lot of the business is done. It's not done actually in the conferences. LinkedIn is one of our favorite places. I used to travel 30, 40 weeks out of the year. That's not fun. LinkedIn, though, is LinkedIn and some of the different things is you can find the people you need to find by going on LinkedIn and start connecting. But what you need to have on LinkedIn, though, is a profile. You got to have an up-to-date profile that looks good. It looks professional. You don't want to half-ass this as well either. Okay. There are private sellers. You start posting, hey, I buy notes, you're going to get private sellers to start sending you some stuff, whether it's on LinkedIn or Facebook or some different Facebook groups. Okay. You can also take it to specific areas and go to the county records, the county recorder's office, and start doing assignment of mortgage searches to see who's filed mortgages. Okay. Those that chase owner finance notes chase deed records. Well, I don't chase deed records. I go and look for different assignment of mortgages from a specific lender to find the right person that I can contact to go from there. Okay. And of course, foreclosure lists. If you're looking for distressed notes, the foreclosure list is going to show them in the bank. Now, I don't target the foreclosure list for the specific property on there, but I use that property as a warm lead to get into the banks, the attorneys, or the right person off the foreclosure list. Now, if you like foreclosures in Texas, you can go to the Roddy List foreclosurelistingservice.com. If you use the discount code WeCloseNotes, they'll knock $20 off. That's good for here in Texas, whether it's your residential list all across each county, or you use the commercial list here. Once again, it's flsonline.com is the website for that, and the discount code is WeCloseNotes. You can also go to foreclosures.com, and that'll be something that's good across the rest of the country. There's also, if you're on the West Coast, you have County Records Research, which is a company that handles like California, Arizona, and Nevada as well on the West Coast. Okay. We've done a longer deals webinar that you can check it out. Finding Note Deals is a great webinar that we've done. Check out that link to learn more about the different ways and do a deeper dive in the ways that we find note sellers. Okay. Now, if you're going to be contacting banks using LinkedIn to contact the right asset managers, there are specific bank department names that you want to contact. Okay. You want to look for people that have a title of special assets department or special assets manager. That's going to be your larger institutions. Okay. Now, you're not going to buy from Bank of America, Chase, Citi, Wells Fargo. Don't call them up and say, hey, I want to buy a note from Bank of America. Not going to happen. Don't waste my time. All right. They don't even know who to contact to buy a one-off note. All right. And you're going to have to buy a $50 to $100 million tranche of notes to do it anyway. Okay. Many of the mid-sized banks and real estate investment trusts have a secondary marketing department. That's good to check out. Secondary marketing department. You can do a whole loan sales department for REITs and insurance companies to find portfolios or notes available for sale that they're trying to move off their portfolio. And when you start getting into banks, credit unions, I don't really target credit unions a lot. Most of them are too small. I don't target small one-off banks most of the time. But you can go to the chief credit risk officer and search there. You can also look at some of the different conferences that are going on. Look for people that are in the secondary marketing or special assets department, or even the capital markets. In some cases, they will handle the note sales as well for you. Okay. So right there should be one of the most important slides of this whole event for you to learn, what department names to use when you're jumping on LinkedIn. Okay. That's the easiest thing, is to automate your LinkedIn outreach. And that's one thing we've done for years, is pull different lists, use a service called Octopus CRM to help automate our connection requests going out to asset managers. Okay. Now, there are some other websites out there. You can go to laneguide.com. This kind of lists a variety of different bank departments, been around for 40 years. It's pretty good. But check it out, laneguide.com. You can go to bauerfinancial.com. Bauer Financial actually publishes the quarterly reports that banks and credit unions have to file for their FDIC insurance. It's called something different with credit unions, but you can actually go to Bauer Financial and call them up and order a list of banks who have 5 branches or greater, and they will literally send you a spreadsheet and talks about how good they are, ratio-wise, percentage-wise, and there's a lot of great information in there. I've seen banks who have the biggest amount of their portfolio upside down or underwater, or how much in default on the residential, or how much is in default on the commercial side. Now, it's not going to give you the perfect contact number. It's going to give you the president of the bank and a normal 1-800 number. But if use Bauer Financial, then you can contact LinkedIn to find somebody in the institution, or go to LendGuide to find maybe an internal department to the special assets manager. Okay. FDIC.gov publishes quarterly reports. You can check that out. You can also use DistressPro.com for that. That's going to cost you a little bit more for Distress Pro. I like the whole, let's buy a list and go from there. Now, here in Texas publicizes their licensed banks, licensed mortgage brokers, or licensed loan officers, or licensed servicing companies who have a license to do business here in Texas. This is a great list to purchase and then market to and say, hey, what do you have in your books we can get rid of? Okay. Now, don't I've got a friend who did a great job of downloading that list and sending an email blast out. But he said, "Oh, I'm with Scott Carson. These guys don't know me from Adam." All right. Now, if you're a one-on-one coaching student, I introduce you to banks and lenders and hedge funds. But this is just a generic list of about 5,000 contacts that give you emails and stuff like that that you can reach out to. Okay. Other states will offer up different licensing websites too that you can download a list of licensed mortgage bankers there. But a lot of states are going to the national MLO, National Mortgage Loan Originators website, where you can search for that for originator or broker individually, but not in bulk. It's okay, but I like Texas. All right. Because it's given me a list for years that I can use. I can download this list, and you used to be able to just go straight to the website and download it. Now you've got to call in and request it via email, and they'll send it to you. Okay. You can also use Scotsman Guide. Scotsman Guide is something I've used for years. They've changed up the website. It's not as easy to find stuff, but what they do, how you use Scotsman Guide is go in and send it, go on there, upload like a lending scenario, especially on the commercial side of what you're trying to do, of what type of asset you're trying to target on the commercial side. And it'll give you lenders, and those lenders are who I would contact to say, "Hey, I see you're a portfolio lender. Do you have anything on your books that you're looking to get rid of?" Okay. Some different platforms out there. You can use paperstack.com, which is okay. There's about 100, 130 notes on there at any given time. It's not a bad place to kind of walk you through the process. And some of our students have bought their first note on PaperStack with our guidance. But I've always found much better deals in other places or by doing my own marketing. Okay. Watermark Exchange is still around, but it really doesn't have much. But it's a good, good idea of what a website should look like. Asset Servicing, you can reach out to Asset Servicing and talk to one of their asset managers. They have notes that they trade on behalf of their clients and others on a pretty regular basis. Deb Expert, they've been around for a couple of years. It's kind of recycled stuff from PaperStack. FixedNotes.com will have some like second and third liens, a lot of junk on fixed notes. Not a lot of good quality stuff, especially first lien. But better stuff is at 10x and auction.com. You can see stuff that's usually going to be commercial stuff on the 10x side. What we do with that, though, is not bid through 10x, is that we find out who the lender is who's foreclosing and then reach out to the director to get other stuff that they got. Okay. Mission Capital Advisors and Debt Exchange are going to be big boys. There's also the Note Trader Exchange out there, which is a possibility for you. I've never bought anything from them. They supposedly got some stuff, but most of the stuff I'm buying is direct from banks and different other brokers that were on their list to get. There's not like a true Note MLS where you can log on like you would trying to buy a property in your area. You've got to do the work here, which makes it, I think, actually much more valuable to us as marketers, because you've got to do a little bit of work. You've got to do something that most people are not going to do. 90% of people or more are not going to send an email blast out to their database. If they do, they might send it once and not do it on a monthly basis or bi-monthly basis. That's where the real magic is in the marketing. Okay. Questions about the different places to find kind of notes for you. No, I didn't give you a lot of names, and I'm not going to give you a list of my hedge funds. That's reserved for my students. But like, you could go to Essence Servicing and click on investors, and there's a drop down for David Polio. Fill out his NDA and send it in to him. And you get his email list. There's a bunch of different ways if you Google mortgage hedge funds or note selling hedge funds, you'll find some traders. Just always be, buyer beware. Before you buy some are good, some are bad, some are just straight up shady. So reach out to me. And their inventory is always going to change. Some of these are basically good. Others are like, not so good. Let's move on. Hey, real estate investors. My name is Scott Carson. I'm known across the country as the Note Guy. And for over 20 years, I've been an active real estate investor focused on buying distressed real estate, distressed notes, distressed mortgages, and foreclosures, and working with other investors who are either brand new or experienced to put their money to work in amazing deals. And one of the greatest tools of wealth building that we have here in the United States is a self-directed IRA. That's right, a self-directed individual retirement account that you can put to work in buying real estate, in buying notes, or lending money to other real estate investors to make above average returns. And our preferred IRA company is American IRA. Right here, guys, they do an amazing job. Customer service second to none. They're out of North Carolina, and Kyle, Janice, the whole team over there are there to support you and help answer your questions when it comes to your investing needs. Now, if you're leaving a job, you've got a 401k or an IRA from a previous company, you can't use that to buy notes or real estate. Now, yes, you can buy it and be self-directed in the funds of the company, but you don't have the opportunity, if you're with a Schwab or Fidelity, to go put that your hard-earned money to work to buy your rental property, to buy a performing note, to buy cash flow, to help you get ahead of your retirement, your kids' education, helping your spouse retire, your parents retire. Self-directed IRAs, like I said, are one of the greatest resources for you to put the power of compound interest to work to help you get to that end goal, what it might be. Maybe it's living more, higher on the hog, or just taking it easy. But if you need a self-directed IRA company, American IRA is the #1 self-directed IRA company with the best customer service, there to help you take advantage of the different loops where you can grow tax-free or to tax-deferred wealth, depending on what you and how you structure it. They can even set up self-directed HSAs, health savings accounts, educational IRAs for your kids, your grandkids, your cousins. All right. SEP IRAs, solo 401ks, besides just your traditional or Roth IRA. Check them out at AmericanIRA.com. Tell them that Scott Carson sent you. You will not be disappointed. You have a wide variety of self-directed IRA companies, but they're not all created equal. If you're looking for great customer service to help answer your questions, to hold your hand, to buying a property or buying a note with your IRA, then check it out, AmericanIRA.com. Tell them that Scott sent you, and they'll take good care of you. All right, so what do you say to get a banker, a hedge fund, a special assets manager to send you stuff? It's pretty simple. Honestly, it's pretty simple if you'll pay attention, okay? Now, I'm a big proponent in the 3-touch approach, okay? The 3-touch approach is basically different ways to touch people. Now, there's a saying I've used for years, and it comes from the American Marketing Association. They're much smarter people than I am, is that 80% of sales happens after the 5th contact. All right, so if you make one contact and that's it, which is what most people do, you're never going to find anything. You might get something, but it's not going to be if you continuously to follow up, okay? So my focus is, if you can find the right person, if you got an email or name, great. Email them, go out on LinkedIn and find them, and connect with them, and then also call them if you've got a number, okay? It's important to keep in mind. Now, what should you not say when talking with asset managers? All right. You're going to want to put together a basic elevator pitch. Now, we have a pitch deck that we teach our students to put together. It's about 10 minutes. So that's good to raising capital. It's also be good for you to put something together like that you could email out, like a short video to asset managers or people that you talk to on LinkedIn. Hey, here's what I'm looking for. Here's what I do, okay? But the biggest question is, when you get to hold of the right person, is what do you have in your books you're looking to move this quarter or next, okay? And these are things that you'll say, we are looking to buy for my own portfolio. We're not joker brokers, okay? We're looking for something with hair on it, okay? If we buy this stuff, we're looking to work it out with the homeowner if we can. They'd actually like to hear that, okay? And we're looking for, non-performing notes in these markets or states. Now, I don't get into saying specific cities. If you call and ask, I only want to buy in like Austin, or I want to buy in like San Diego, that's a no-go, okay? Don't do that. What I say is, listen, we're looking to buy for non-performing notes in most of the major metroplexes in most states. Now, we won't buy in New York or New Jersey. I'll just tell them that. But we do buy in most of the major markets across the country, okay? That keeps it simple. What you want to keep in mind is you want that asset manager to be able to hit the download button for the Excel spreadsheet for their tape, to download it from their system and then attach it in an email to you. If you ask them to start going through and, looking through their whole list to find one note in Austin, Texas, or one note in Baltimore, Maryland, that's a waste of their time. Get the whole list, and then you do that deep dive, okay? But do not say this. Don't say, hey, I have 20 million a month to buy. They can smell that as fraud and fake a mile away. So can I. Somebody says I got 20 million a month, I'm not going to even take my phone call. I'm not going to take their phone call, okay? Don't say I'm looking for notes and REOs. This is a true sign of a joker broker. You're only calling for notes. If you're looking for REOs, which is real estate owned, which that's a foreclosed property, the bank's just going to send you, or whoever you're talking to is just going to send you to their website to check out their REO listings, or call the listing agent, okay? You're not going to get, now, do I get REOs sent to me? Yes, I do, but I don't ever target those. I target notes, and occasionally we'll get REOs sent to us too. It's like, hey, we got this other stuff you're trying to move. Okay, great. But notes have always been the bigger passion to get that stuff sent in. Now, yeah, you'll have some banks say, hey, we don't sell our notes. Okay, that's fine. Move on. If somebody tells me that, though, or they tell me, oh, we don't have any non-performing, I know they're full of BS. Okay? Every bank's got non-performing stuff. Now, might be one off or two off notes, but guess what? They're going to have some stuff available for you. Don't say I'm looking to broker or wholesale. They don't want to hear that. They don't need your waste. They don't want to waste your time with a joker broker or wholesale. Now, when I get a tape in, if there's nothing on it that I like, I then will ask them. I say, listen, hey, Gene, or whoever sent me the tape. Nothing on this that I want, but I do know somebody that might be interested in one or two of your assets. Would it be okay if I shared those assets, that information with them? Because most of the time the banks are going to make you sign a non-disclosure agreement, an NDA. And it says you're not going to go blast it out there. That's fine. But that's why I say, hey, I got somebody who'd be interested maybe in this property here, that property there. Could you put yourself in for a point or two? Yeah, you could do that. Broker it that way. It's much more smarter than saying I'm a broker joker, okay? Or I'm blasting stuff out. Don't do that, okay? Don't say I represent a buyer's rep or buyer's mandate. Ugh. That just makes me vomit. Or I'm looking for anything. Send me anything you have. First, seconds, residential, commercial. That screams joker broker as well, okay? When people ask me, what do you buy? I'm buying non-performing first. I like, residential up to $1 million. And I like commercial, small balance commercial. 2 to 5 million is kind of the best aspect of the small balance commercial. Anything above 5 million is probably getting gobbled up by hedge funds. Okay. But that's what you want to keep in mind. Don't say these things and don't say I'm looking for a specific code or city. That's just a waste of time. I like Austin. I live in Austin, but I buy outside of Texas. Okay, I buy all across the country. It just adds confidence. Because the same thing too. They'd rather deal with one person who's buying in multiple states than one person looking for one zip code. Just not a pain. It's just too much of a pain in the ass. Okay. Now, best times to email bankers, if you've got an email list, is to send it multiple times. Okay. But if you got like doing an email blast out, send it out on a Tuesday, Wednesday, or Thursday, either morning or afternoon. All right. Between 10 a.m. and 3 p.m. their time. Okay. There are services like MailChimp or Keep or BlackBook Aria that allows you to kind of send it out of different time zones or different times. Do that. Use it to be smart for their time zone that allows you, okay? The reason is you send it in the morning or your first email you send out, you're going to see about a 10 to 20% open rate the first time, okay? But make sure your email is professional. Make sure it's got your logo. Make sure you've got a link to your LinkedIn. Make sure it's not just in text. Do an HTML. Okay, HTML will automatically convert it to text as well for you. Okay, but make sure it's grammatically correct. Make sure it looks decent. Don't just send out, "Hey, I'm looking at your notes. Send me what you got." And also don't put like all your social media links on there. That's not a professional aspect. But just get in the habit of following up and looking professional. In our 3-day class, we give you several sample emails to look at to help you kind of design your stuff. Okay. Now, the first time you send it out, you'll see a 10 to 20% open rate. The second time you send out to your list, you'll see a 5 to 8% open rate. Third time, maybe 1 to 4. But combined, that's somewhere around a 16 to 32% open rate, maybe even higher. Okay. And the thing is, you send your email out to the first one. Okay. Your first list, you get 20% open rate. Guess what? You send that same exact email to the 80% that didn't open 48 hours later. So if you send it out on a Tuesday morning, send it out on a Thursday afternoon. You send your third email out on Tuesday afternoon instead of Tuesday morning. You see it's kind of flip-flop a little bit, okay? But get in the habit of sending out because, yes, well, Scott, won't that person see my email 3 times? If they didn't open it, okay, who cares? Get them, touch base with them at different times. Some people may be busy. When I was a banker at JP Morgan Chase, my email would be flooded with a bunch of stupid stuff. Okay. If somebody sent me an email reminder, hey, just wanted to touch base. Oh, I wanted to follow up with them. Okay. Now, if they unsubscribe, they unsubscribe. Okay. Whoopie-doo. If their email bounces, you're often maybe going to get a out of office email. Hey, I no longer work here. Contact John Smith or whoever. Guess what? Pick up the phone and contact John Smith or email John Smith what you're looking for. This is the smartest way to get deals sent to you. It's much cheaper for you to spend time sending out an email blast and more effective than sending out a drip marketing campaign and paying thousands of dollars in stamps and postage. And you don't even have an address to send these to. Do not send direct mail to asset managers, okay, or bankers. It's just a waste of time. Now, I do send like a thank you card if I get their direct mail address after we closed on a deal or something, okay? But that's the thing. Sending an email is still effective. It's very effective. And most people won't do that. And that's why you have most people say, well, there's no notes out there. Yeah, there is if you'll get off your ass and go market, okay? Now, picking them up and calling is just as important. So what I do, we get a list in, we email it out. Tuesday goes out. Wednesday, I'll start looking at those that have opened the email. Now, if I've bought a list or gotten a list from Link Guide or downloaded a list, guess what I'm going to do Wednesday when I start seeing people have opened? I'm going to start calling. All right? Or I'm going to go over on LinkedIn and try to find them on LinkedIn. Okay? Same thing. Calling asset managers is good Tuesday, Wednesday, Thursday. Don't call them on Monday. Don't send an email on Monday. Same thing. Call them between 10 and noon and 2 and 5 their time. So it's a little bit different time frame. If you don't have a lot of time during their time, but let's say you're on the East Coast and you're trying to contact somebody on the West Coast. Okay. Now, the big thing here, guys, most of your asset managers are going to be East Coast or West Coast. Yes, you can call California for different departments. There's a lot of special assets and stuff like that where the main department's out there, but they lend all across the country. You get what I'm saying? So if you're on the East Coast, you probably have to call at night once you get home at 5 o'clock to try to reach somebody by 2 or 3 o'clock. Okay. If you're on the West Coast, you're probably going to have to call before you go to work or something like that to reach somebody in the afternoon on the East Coast. So just work through that and leave plenty of voice messages. You call somebody, always leave a voice message. Hey, this is Scott Carson from WeCloseNotes.com. Just trying to target, I think you're the right person at ABC Bank who sells your non-performing notes. Love to talk with you. I can be reached back directly at 512-585-3810. Or you can email me at scott@weclosenotes.com. Get you an email address, a professional URL that's easy to state. Okay. Also, don't go out and create you an info at or contact us at or sales at. That's okay for back end. That's not appropriate for forward-facing folks when you're trying to contact them. Okay. That gets info at, sales at, always hits the spam filter first. Okay. But speak clearly, slowly, smile. All right. Have your elevator pitch down below 30 seconds and repeat your phone number twice. Okay. Very important to do that. Smile. If you're having a bad day, don't call banks. People can tell them. If you're mumbling, don't do that. Hey, this is Scott Carson. I'm with WeCloseNotes.com. We buy notes for our own portfolio. I believe you're the right person to handle your non-performing note sales. I'd love to talk with you. We've been buying notes for 10 years or 20 years or whatever. You can reach me directly at 512-585-3810. Once again, it's 512-585-3810. I know some people, they'll hire like voice dialers. You can do that. I don't think that's a good thing to do because you can tell these days when it's a voice dialer. You're going to be contacting like asset managers and you're probably going to get a hold of their assistant or secretary or the corporate office of the bank. You need to speak to somebody there quickly. Okay. Now, we've always put together a ratio, and it always seems to work out roughly about this way. It's actually gotten a little bit better over the years. But we knew that if we made 50 phone calls in a day, I would probably talk to an average of 14 people. Out of those 14 people, I would talk and sign probably 4 NDAs. Okay. And I'd get one tape or one pool sent to me, or I'd find somebody that had tape. That's a pretty good return. If you're getting a tape of 100, 200, 1,000 notes, and it makes you 50 phone calls to get to that, every no you get along the way is worth something. Okay. But remember, if this is a follow-up basis, okay. Now, Scott, I work full-time. I don't have time to call banks. That's fine. Then focus on LinkedIn and the email blasts. Okay. Or scheduling time to follow up and use a calendar link to get people to book times when you're available to talk. Okay. But expect a follow-up. Follow up, send the email, make a phone call, connect on LinkedIn, and continue to follow up. And always say, hey, if you're not the right person, who is the right person? Okay. Who is the person I need to talk to that I don't have to bother stalking you anymore? Okay. But keep that in mind. 80% of sales are made after the 5th contact. If you sent one email out, great. Expect it to be a process. That first email is probably going to suck the worst. If you're planning to send an email, please run it by me first before you hit the send button. The last thing you want to do is send an email out that looks like ass that people just go ahead and block you because it looks like ass. You're a professional. You're dealing with bankers. You're dealing with institutions. You have to act the part. Okay. Now, those that you talk to, put those in a hot list. So you don't have to blast them the same email every month, but it's still kind of good to do that. And just say, hey, like if I say Albert is an asset manager and I talk to him on the phone, I'm gonna put his email on a hot list. I can just do a much more informal email to him. Say, hey, Albert, hope your month is going well. Just wanted to touch base. See if you had anything new in your books you're looking to get rid of. Okay. His name is going to be on the hot list. It'll be a little bit different than my main asset manager list, but I'm still going to drip market in the main asset manager list every month. You never know who's going to see. And like I said, if somebody leaves or out of office, spend time to go into your out of office responders and see who says what. You can often find some great contacts in there as well. Okay. We've called asset managers for years. There's a long 4-hour video of me calling bank asset managers on this link. Go watch it. You'll hear me talk to asset managers, hear some of the conversations, the things that I say, things I don't say too are just as important, and kind of the responses back and forth for you. So it's good to check it out. Okay. One of the things too, we give you scripts. We show you exactly what to say in our 3-day workshop. You can go to nobuyingfordummies.com, check it out. Our next class is actually in April, just over a month away, the 18th to the 20th. It's online via Zoom. We had an in-person class here about 3 weeks ago here in Austin. We'll do that again later in September, an in-person class again. But our online class will be a lot of the same content, diving in. It's me teaching it for 3 days. We'll have a few guests along the way, but it's an opportunity for you to dive to. It's really, really great. It's the #1 resource for folks, especially if you can't travel as you get to near the end of the year, as kids graduating and college graduations. But check it out. Go to notebuyingfordummies.com. We're running a special on it right now to make it worth your while. Okay. Now, if you can't sign up for the class, you might want to check out our monthly membership at $97 a month. That's kind of the all-you-can-learn note buffet. It includes access to the replays of classes, access to the tapes. Like we just uploaded a list of notes. Actually, we uploaded quite a few lists of notes of the last 2 weeks to our students there to take a look at. It gives you access to the replays. $97 a month, biggest bang in the industry out there for you. Go to noteumbrella.com and get signed up for that. That's noteumbrella.com to get signed up for a monthly membership. Okay. All right. All right. So one of the biggest questions we come back here in session 5, people always ask, where should I buy and where are the best markets to buy in? What's kind of pricing standards? How do you price a non-performing note, that kind of stuff? And that's what this is all designed about, to help you out there. Now, I'm a big believer in transparent pricing in a lot of cases, especially if you're buying a note from me. I'm not going to buy a note from a portfolio or a portfolio sent to me and then jack it up $30,000, $40,000 and take most of the meat off the bone. I'm buying from my own portfolio. I don't feel the need to say, hey, let me go ahead and slice off all the profits so you make a skinny margin. Some educators want to do that, and that's fine. Let them do that way. I believe there's plenty of inventory, plenty of great deals to go around that you don't have to be beholden to me. If you're going to buy a note from me, there's going to be a fee probably involved with it, but it's going to be a smaller fee, a wholesaler fee. If I'm getting a really good deal, I'm going to give you a really good deal on the back end side too, but I'm going to make some profit as well. Okay. If I'm wholesaling notes, I'm not going to charge you a ton. Like we're working on this portfolio of performing notes. Well, performing notes, you can't charge 20, 30 grand. I'm like, hey, just give me 1% off whatever the funding amount is as my fee for helping you buy that note or helping you sell that note. Okay. That's pretty normal when it comes to the profit margins on a performing note. But let's dive into some stuff and help you answer that bigger question. So market expectations here, markets can vary based on the popularity. Like I said before, Austin, Texas is more popular than Austin, Minnesota. Miami, Florida is more popular than Miami of Ohio. The values, obviously, when the median value of homes is like 500, that's going to be different than say where it's 100,000. Okay. Pricing in Ohio is cheaper than it is here in Texas. Also, foreclosure timeframes. New York, New Jersey, huge. New Jersey's got about a 2-year foreclosure timeframe unless it's a vacant property in 6 months. New York is like 3 years. That's why I don't buy there. And you can buy a lot of cheaper stuff, but it does not make it a good deal because it's a difficult market to evict somebody or to foreclose. Okay. Also, you want to stay probably away from the rural areas, the small markets, unless you have intimate knowledge of that area. Like I grew up I'm a South Texas boy. Okay. Grew up down small town near Corpus Christi called Ingleside. I think there's 10,000 people there. Okay. It's 3,000 when we moved there years ago. Okay, I would not buy that if you're brand new. Like Albert, who's out in San Diego, it doesn't make sense for him to buy a note in Ingleside, Texas. It's too small a market. He doesn't have the connections. In small markets, there's less realtors, there's less people to go out and force stuff, there's less buyers, right? So stick to most of those, decent sized cities. I say 50,000 greater. That will help you out. Okay. Now, as you get going, it would make more sense for you to buy in those areas if you have teams that can go take care of it. If it's near a major city that you like, that's good. Okay. But like I said, I don't want to buy something out in the middle of the country, where it takes 20 minutes, 30 minutes to get there and there's nobody around. That's not a good thing unless you're looking to buy land. Now, I'm looking to buy some land. I don't mind buying a little rural if I'm going to buy some acreage or a house with some acreage on it that I can take down. But the harder it is to get there, the fewer people there, the less buyers, the harder it is for you to get a good deal and make sure. Otherwise, it may be a good deal, but could turn into a dud really fast if you've got issues. Okay. There's a group of students that thought they were very smart. We're going to buy a portfolio of these low valued assets that are all across the country, and we're going to owner finance them. I said, well, are they in major cities? Like I didn't even recognize the cities. Like I'm like, I don't know. I would not do that. Well, we know better. Well, they got stuck with them all. We're going to owner finance them. Well, nobody was there to owner finance them, or nobody had the 10, 20, $30,000 down. It turned into a bunch of duds. So I'm here to try to help you, ladies and gentlemen, avoid those issues. And now, if you lived in that area, and we've got a lady that we're helping out. She lives in kind of rural Arkansas. She's owner finance, or got like 40 properties. She's owner finance. She's got a niche there. Okay. She's got it down. She knows her market in and out. And that's a different story. She's embedded in there, right? She's not halfway across the country trying to do that. Okay. So rely on your vendors. And then, of course, too, look at the inventory in those areas. People come to me all the time. Oh, I want to buy in LA, or I want to buy in San Francisco. Okay. I don't see a lot of stuff there that makes sense discount wise. All right. Oh, I'm buying in Portland, Oregon. Well, good for you on that. If you don't live in those neck of the woods, you probably don't want to be buying in that neck of the woods. Okay. Now, what is hot? The most expensive note markets out there. It doesn't mean it makes sense. Hot means that they're most expensive. California is still overly priced. Arizona is cooling off. There's actually some really good deals. I actually like Arizona. Get a lot of California buyers who buy in Arizona and Nevada as well. Texas is always really the number one state people like to buy in. And you'll see some stuff here. We've seen more stuff here in the last year than we have seen in a while, all across Texas, Dallas, here in the Austin area, San Antonio, Houston, South Texas is kind of stuff that we've seen. I never saw a lot of stuff down in Corpus Christi and above, but we're seeing more and more of that stuff. Okay. Nevada, you see some stuff there. Georgia is also hot because it is a fast foreclosure state, but you've got to have that licensing thing. Okay. Stuff on the West Coast. Yeah. If you get something there, okay. I wouldn't buy it for myself, but there's plenty of people out there that'll buy something important in Washington State. Sell it to them. Don't make that part of your headache. Okay. Now, what's not the least favorite markets? New York, New Jersey. Just avoid them like the plague. I don't buy in Kentucky. Kentucky's got a weird law where they want you to have if you're buying under your own name, a personal bond of $500,000. If you're buying an LLC, $1 million bond. Just too expensive, and it's not. There's only really two cities, Louisville and Lexington, I'd buy in anyway. But most of those, I would just go elsewhere. Okay. Kentucky's like one of those states that's just easier to buy an REO in. Okay. Avoid Chicago, avoid Cook County. It's horrible to foreclose there, especially if you live out of the area. Just avoid it like the plague. Trust me, you'll be happier by not buying in there. And then also, too, as you start getting in tapes, you'll start seeing how to slice and dice. Start reading of stuff that's below $30,000 at fair market value. Now, I bought a lot of low value stuff a decade ago because markets were different. But right now, if it's under 30,000, it's probably a POS. That stands for piece of excrement, if you know what I'm talking about. Okay. Also, too, here's another thing. Flip this thing. Avoid high equity note deals. Because the fact is, if it's got a ton of equity above the legal balance, okay, the lender is going to want you to come in 80, 90 cents of the dollar. Now, some states that might be good. Other states, that's going to be way too skinny. Okay. Like I had some offers in from a hedge fund that we buy from, and they had some stuff that was like $100,000 value. They were owed 40,000 was the balance on it. I offered 20. They came back and wanted 90 cents of the dollar. They want 36. I'm like, look, that's great for you guys, But if I foreclose on this asset, if I paid 36 for it, 40,000 is the legal balance, I only got $4,000 potential in profit. It's going to cost me half of that to foreclose, and that doesn't make any sense. Now, can I flip the coin and roll, go to Vegas and roll if it sells at the auction? And then if it doesn't sell, I get the property. That's great. But that's too skinny a deal to risk putting my investor money into something that could take 6 months and we only end up with like 2 to 3 grand. Okay. So just keep that in mind. You'll see me talk more about this if you're part of our coaching and stuff like that, and helping avoid deals that makes, avoid those deals, focus on stuff that makes sense. Okay. Now, where is the most inventory at? I've talked about this: Ohio, Michigan, Indiana, Illinois, outside of Cook County, but you'll see plenty of stuff in those 4 states. Okay. Used to be Florida was in a lot there. You still see a lot of stuff in Florida. Missouri's starting to peak up there. Also Kansas some. Florida, I would really, if you want Florida stuff, stay inland. Stay away from the coast right now. The insurance costs will kill you. Avoid condos. Condos are about to be a nickel a dozen, basically. Especially on the higher rise, the older stuff with all the issues that they're dealing with. And they still may not make sense to buy them at that. Okay. We are seeing also an increase in reverse mortgages, vacant reverse mortgages where the borrower's passed away and the bank is now foreclosed. Now, reverse mortgage is not a cash flow play. It is a foreclosure play. Okay. A reverse mortgage can be very valuable and can make some good money on reverse mortgages if you buy them right and they're in pretty decent shape. All of them are going to be outdated. All of them probably going to need paint and carpet, appliance updates, maybe bathroom updates, depending on how old the individual was that passed away. But you're seeing some opportunities there. But it's a foreclosure play. It's a straight up foreclose rehab. You either sell it at the auction or take it back and rehab it. Okay. You also small balance commercial real estate too, sub 5 million. You're seeing more of that stuff. And that's more so to looking at your local markets and a lot of that stuff too. A lot of your banks will have that small balance commercial stuff. They may not be willing to sell it off at big a discount now, but the more it goes in default, and I think more and more banks I see are starting to take the discounts on the commercial estate to get off their books because it's starting to really be an albatross, dead weight, loose cannon across their whole portfolio. Okay. Now the pricing models, this is going to vary. I get some people that get their panties in a wad when it comes to one aspect of it. Oh, you can't use that. It's like, this is a guiding model. Okay. It's a guide. There are times when banks come back with price. I'm like, you're smoking crack on that. I'm not going to pay that for that. There's no reason for me to buy that. Okay. The first one is looking at non-performing negative equity. That's something called the stair-step model. I'll show that in a second to you. Okay. But this is where they're upside down. They have no equity. They owe more than the property's worth. Okay. Then you have non-performing with equity. And like I said before, sellers may want you to pay 80 to 95% of either the unpaid balance or the legal payoff balance. Is what PO stands for. That might make sense. It might not make sense. Okay. You got to look at the numbers and make sure if you're buying it at 80 cents on the dollar and that 20% is good, and it's going to be a good enough return that if you do sell it at auction and at 20%, that's a good win. If you don't sell it at auction and now own the whole property, that upside's gonna be huge. Like my buddy Cal's got a great deal. He paid 80 cents on the dollar off of payoff, got it accepted. He worked out a cash for keys deal with the borrower, which enabled him to walk away with more profit once he finishes selling the property. He gave the borrower some money of their equity, so they avoided a foreclosure, got out of the property, and now he owns the whole property. Okay. Contract for deeds. We've seen pricing at 30 to 60% of less of the UPB or the fair market value. Most of these will also have equity now in a lot of cases. So 30 to 60%, especially if it's non-performing. If you start getting up to it's performing up, then refer to, probably 80 cents on the dollar if it's performing. Junior liens, don't waste your time with seconds. Sorry, just don't waste your time. I don't waste my time with them. Commercial properties, that'll vary by cap rates, the asset class, and what's going on individually. If you're interested in multifamily, you're interested in RV parks or self-storage, go get educated by somebody who's operating that commercial asset so you can understand how to read the numbers. Rent rates, comps are pretty easy for residential for you here, okay? Now, you're always going to submit a bid either as a percentage of the UPB or as a flat number minus taxes. Take the time to jump on the county websites, the county assessors, the tax assessors to find out how much is owed in back taxes. You can do that before submitting bid, but it's pretty simple. You're not doing anything fancy. Either send in a spreadsheet with your bids or send an email and say, hey, here's the loan number. I'm making an offer at this amount. Pretty simple process, okay? Now, when it comes to the stair-step model, this is, remember, we're talking about where they're negative equity, they're upside down. If you get down below here, start it and work your way up. If it's basically the asset has a value of 30,000, okay, or less, don't offer more than 25% of the fair market value. This is where they owe more. So if it's only worth 30, maybe they own 40 or 50 on it. Okay, well, I'm only going to make an offer at 25% of the fair market value. In this case, it was 30. That would be $7,500 minus taxes owed. Okay, so there's $5,000 back taxes owed. I'm only going to offer 2,500. Okay, if you get something that's in the 30s, 30 to 39, 35% minus taxes owed, in the 40s, 40 to 40, 49, it'd be 45. If it's in the 50s, 55%. 60 and above, you probably need to be in the 60 range with negative equity. Okay. Now that number may increase if it's closer to foreclosure. Like if it's almost, like if you buy something in Texas goes to foreclosure next month, you might need to be at 70 cents on the dollar of the value if they owe more than the property's worth. If it's in New York or New Jersey and you're wanting to buy there, you'd probably be closer down to 60 or 55 because of the longer foreclosure time frame. Okay, so keep that in mind. It's just a guide. You can increase it or decrease it depending on the strategies or what's going on that can affect in a positive or negative manner when it comes to foreclosing. Okay. Now, I prefer to target occupied assets except on the reverse mortgage. Reverse mortgage, the borrower's dead. Okay. You're not going to get somebody to come back and start paying their mortgage from beyond. If you did, that's kind of a ghoulish business model, if you ask me. Okay. Usually if it's occupied, they're going to be in better shape. Somebody's taking care of the property. I mean, you're still going to have to do some usual maintenance, paint and carpet. Like, I'll give you an example. Cal bought this one. It's in great shape, but it does need paint. It does need carpet. I mean, somebody's lived in it for 20 years. It's still updated. You won't have to touch a single light shade on it, or the bathrooms are updated, except maybe swapping out a couple toilets and cleaning up some cabinets. But it's in a much better shape. If it was vacant, who knows what would happen? People breaking into it, people stealing the AC. If it's occupied, you've got more exit strategies. You can get the borrower back on track. A loan mod, a deed in lieu, a short sale, assumption. If it's vacant, then you're either trying to get, it's basically a deed in lieu or foreclosure. Okay. They're easier to reinstate, modify. It's easier for doing a deed in lieu cash for keys because you get somebody to talk to there, and their emotional equity. If somebody's thinking about moving on the property, you can use that emotional equity. Especially, hey, instead of you moving out of the property, why don't we take that money you would use to move and deposits and put it towards your balance and keep you in the property? There's less capital expenditures when somebody's living in the property because they're usually maintaining it with the roof, the air conditioning, heating, the wiring, the plumbing. Somebody's making sure it's operating. That's a good thing. Okay. That's the thing. If it's occupied, I look at, okay, is it occupied or when was the last payment made? If they made a payment in the last 12 to 24 months, okay. Somebody wants to stay in at some point. Let's figure out what's the issue and go from there. Okay. Questions before moving on to different funding options. And I am monitoring the YouTube stream. So I see some folks on there. Good morning. Give me a shout out there on YouTube, everybody. Hey, real estate investors, this is Scott Carson. I'm known across the country as a note guy. For the past 20 years, I've been buying distressed assets, primarily non-performing notes on residential commercial properties. And if you've ever wanted to learn how to dive in to start buying non-performing notes from banks, hedge funds, or other investors like yourself, then there's no greater place than to get the nuts and bolts, the A to Z, the 1 through 99 place to get started. It is our virtual note buying workshop. We've been teaching this class since 2010 on how to find, fund, flip non-performing notes, how to get banks to call you with deals that you can cherry pick. And no, you don't need millions. No, you don't need a lot of experience to start looking at non-performing notes. We get lists of notes from banks, hedge funds on a regular basis, not one or two or three or four, but hundreds of deals that we can evaluate and cherry pick. Whether we're looking for performing notes or non-performing notes that we can get reperforming, or non-performing notes you can foreclose and take back, whatever your niche or whatever you would like to focus on, we can help make it happen at the virtual note buying workshop. It's a 3-day class. Our next one is April 18th to the 20th. It's actually online live via Zoom. You get signed up by going to notebuyingfordummies.com. That's notebuyingfordummies.com. Day one is all about how to find these assets. How do you find asset managers? How do you find lists of people to reach out to that you don't have to spend thousands of dollars on postcards or letters that you waste money on? We don't do that. Day two is all about raising capital and marketing and how to create a business that feeds itself, that you can do part-time, 10 hours a week, 5 hours a week, depending on what your focus is. We'll show you a game plan to achieve deal flow coming in on autopilot versus you having to send a ton of money. And also, we'll show you how to raise capital like nobody else does. And then day three is all about the flip. How do we structure deals? How do we evaluate a tape to find the deals from the duds? All right. We'll show you what vendors to use. We'll give you a 200+ page manual, contracts, sample forms, all the stuff that you need to be a lean, mean note buying machine when you get wrapped up. Now, yes, this is live April 18th through the 20th online via Zoom. Get signed up today. We'll send you the replays of the previous online workshop so you can start learning, start evaluating material, and get rock and rolling. And if for some reason you don't like our class, we have 100% money back guarantee involved with it. If at the end of the first day you don't like what we talk about, you don't think it's impactful, just let me know. We'll refund back your tuition, no questions asked. We don't want your money. We want you to become a note buyer. We want you to become a lien lord. All right. Like I said, if you're tired of dealing with toilets, sinks, and trash outs, you don't want to deal with renters, then becoming a note investor is the path for you. Everybody evolves into a note investor at some point, but there are plenty of opportunities out there. There are millions of non-performing notes that you can cherry pick. No, it's not all junk. It can be small value all the way up to $1 million homes or $1 million apartments for you. So much opportunity is taking place right now in the chaotic market that we see. And who's going to come out on top? Note investors will. So take the time, get signed up today, April 18th to 20th. Go to notebuyingfordummies.com or go to our website, weclosenotes.com, and sign up for the virtual workshop there. As always, get signed up today. We run discounts all the time. The cost of tuition is you plus your partner or spouse. So get signed up today at notebuyingfordummies.com, and we'll see you at the top. Now, how do you buy a note? What are the different funding options for funding your purchase of a non-performing or performing note? Now, how do you pay for a note? You're going to be paying in wire transfers, cash from your bank or your funding partner's bank or IRA direct to the bank, direct to the lender. There's not a traditional like closing at a title company like you would normally. There's no title being transferred. Okay. The existing title is still in place. It's the same borrower. So if you're buying a note, it's just that you're buying that debt. The borrower still owes the full amount, and sometimes that can be people can be a little nervous about that. So you may need to set up an escrow account where your investor funds money into it, and then you wire the funds out to the bank directly. They send a bill of sale and then the assignment of mortgage a couple of days later. Okay. Now you can use a personal and business line of credit. Some people have used that. You just got to make sure that your costs for a line of credit don't exceed what you're making, or it's just temporary that you're using that money for the purchase and then refinancing out with other money or OPM. Okay. Check out getfundable.com. Our friend Merrill Chandler over there does a tremendous job in helping people get unsecured business lines of credit to go fund real estate deals. Phenomenal guy out there. We're gonna have him on the podcast later this week as well, I believe. And then just check it out. It's what he teaches. Everybody should learn in high school or college about when it comes to credit as well. Okay. He's also got a boot camp. He usually teaches a couple times a year. It's like a 2-day class. Go to getfundablebootcamp.com to check it out too. But most of the time, if you don't have your own money or don't have a retirement account or an IRA, you're going to use OPM, other people's money, to find stuff. Now, we target a lot of people that have a self-directed IRA, whether it's a Roth, a traditional, a solo 401k, even educational savings accounts. You can even use a self-directed HSA, a health savings account, to buy notes. There's a whole variety of different types of IRAs that you can use, whether it's your own money or borrow money from other people out there that have that. Okay. Now, if you don't have an IRA, you definitely need to go get an IRA and start putting that money to work. Or if you got an old 401k from a previous job, get it rolled over into a self-directed IRA that you can use to start funding deals or start lending to other people. Our preferred IRA company is American IRA. They're out of North Carolina. Very easy to deal with. You just go to AmericanIRA.com, tell them that I sent you. They'll take good care of you. Okay. And here's some of the contributions increases that have come this year. So if you're doing a traditional or a Roth, it's still about the same thing at $7,000 total. But if you're 50 or older, you do have a catch-up clause and put up to $8,000 in there. All right. 401k, employees 23 is 69,000 total. That's increased by $500 to 23,500 for your employee, or total of 70,000. And HSA has gone up by $150 an individual from 4,150 to 4,300. Family has gone from 8,300 to 8,550. Whoops. Solo 401k went up by $500 from 23,000 to 23,500, and a SEP IRA has gone up by $1,000 from 69 to 70,000. Okay. Other ways to fund, collateralize your deal if you don't have your own money. You can do a collateral assignment. This is where basically the person that's going to be funding your deal holds on to the collateral file, the loan file they hold on to. They may also file a UCC1 in the county against your LLC just to make sure that, if you don't pay, they have the right to foreclose and enforce that to get their money back. It's pretty easy to do. You could also do a co-assignment of mortgage. This is simple enough that what gets transferred or recorded to handle the note sale is not a new deed. It's not a new lien. It's an assignment of mortgage. So if ABC Bank sells a note to me, it's going to be ABC Bank to Inverse Asset Fund, LLC, right? Well, if I have an investor going to fund that deal, I can, if they want to show something on title, that's fine, or something on the county, very easy. We'd have ABC Bank and or assigns, to 50% interest to Inverse Asset Fund, LLC, and 50% interest to Albert Kim, LLC. All right. That's pretty easy to do. Now, in some cases, banks or lenders don't want to change names on the assignment. So what they may say is, okay, we're going to create an assignment from our bank to your LLC. If you've got an investor, what you would do is do an assignment from your LLC to 50% your LLC and 50% their LLC. Not that difficult to do. Just shows they have some interest, and then you outline what that interest is. It's not an interest rate. It's just interest in the deal with your funding agreement. It's a flat funding agreement. Like, hey, they're going to get 8% for 24 months on the deal. You're not going to give them equity. You can't give an individual investor equity in a deal. That'd be a violation of securities laws. Just a flat interest rate, flat loan, not, I'll give you 50% of the deal. No. If they're going to do 50% of the deal, then what you could do is have them create an LLC with you, and then that LLC, they fund the LLC, and then the LLC goes and does that, and then you split it up by your operating agreement, okay? If you got other property, the real estate, you could have them slap a lien against that property as security for the money that you're borrowing from them to go buy that. That's pretty simple to do. Or if you've got a portfolio of notes that are performing, you could sell off some partials, some payments for a period of time for a lump sum to help pay for your investment or the deal that you're buying. Okay. Like I said, I don't usually start a new LLC with an investor unless they're going to put 250 or more in a deal. If I know that investor and trust that investor, we'll have an operating agreement for that deal, and may even fund it in their own LLC if they're comfortable with that, and go from there. Okay. Or you just have your investor fund your LLC and they're off rock and roll. Okay. Now, people ask me all the time, will a bank give me a note loan? No, they're not going to give you a loan on a non-performing note. Banks will not lend on a traditional non-performing note. Now, some hard money lenders have local relationships with banks, so that they go make a loan for 200 grand on a hard money deal. They'll buy that note or collateralize that note to give them, say, 50 cents on the dollar of 100 grand to go do another loan for. Some will do that, especially in hard money loans where they're 6 to 12 months of short term. That's a way to cross collateralize. Some banks will even go 70, 80%, I found out too, to help you out with it. 50% or greater. All right. Now, some banks that we buy notes from, especially on the commercial side or when it's $1 million plus note, may be willing to carry financing on that note, but it's usually got to be a 7-figure note where, okay, so if it's bringing full 7 figures, we're only bringing 10 to 20% of the note purchase. And once we buy that note, then it's the bank holds a collateral for it, obviously. And if we do foreclose, then it becomes an REO, and then the bank will slap a lien on the property in the first lien position, which is fine. They just don't want to lose that relationship, Commercial notes, they may even joint venture with you on the commercial notes. We've seen these on some of the banks that we bought, like Synovus Bank, on their loan sale agreement. They say, hey, if you're looking for some sort of joint venture partnership, outline the deal and negotiations, and we'll think about it, okay? But it's usually got to be on $1 million plus loan. You're not going to have it on a $30,000 loan. But you've also, too, what's important thing is you don't necessarily need to have the experience in flipping that or doing that stuff, just as long as you have a team, somebody who's experienced that you can reach out to, partner with on the deal. Okay. And like I said, it's always better if you only have to put 10 or 20% down than putting 100% down, right? And buying that note cash. All right. Um, can you buy hard money loans? Yes, you can buy hard money loans, but hard money lenders won't lend on notes. They like short-term loans, 6 to 12 months. So they'll sell it on the REO side, but they're not usually going to lend you money on the non-performing note. They want to control the asset. Even though they're creating notes, they're in the note business, they just don't seem to get it aspect of things. Now, here's the thing. Since they're only usually lending at 70% of the property, they're usually not going to sell you at a big discount unless it's really in a rough area or is a tough shape on the deal. If they're going out of business, they may be willing to liquidate if they can. But for the most part, they're not. Now, you can buy hard money loans at usually a pretty good clip, 8, 12% or greater. You know, if you've got some money sitting on the sidelines, that might make sense to do it because usually these deals are 6 to 12 months. But we have started to see a lot more hard money loans go into default as well. That makes for some interesting times. Okay. Now, the question is, well, Scott, if I'm going to buy a note, say at 50 grand, what else do I add to the funding agreement if I don't have the money to foreclose or don't have money to do the rehab? Well, here's the go. Look at the first thing you got to look at is the property taxes. Do you have to pay the taxes now, or can you wait to sell it, pay the taxes when you sell the property? If there's back taxes owed of more than a year, you might want to go ahead and pay part of the taxes. If it's about to go to tax sale or tax certificate, you want to go ahead and pay that off to avoid losing it, okay? Look at your values from your broker price opinion or your CMA. Look at days on market. That's definitely an important aspect of things when reading your BPO. But then you may want to increase some stuff. Always put eyes on the asset, make sure it's the right asset that you're evaluating is the right value for that property, not an empty lot or a slab or anything like that. But these are some of the things you want to start putting in, like budgeting your foreclosure costs, taxes, workout, servicing costs. You might even want to put in some, if you know it's vacant, you may want to go ahead and figure in that, hey, we need to go ahead and add some extra to handle the rehab if we take it back. Okay, clean out paint, carpet, some of that simple stuff. Force place insurance, you're going to need to put insurance on it. All right. So some of those costs can add up. If there's liens, HOA fees, stuff like that, that won't go away. Water bills from a previous tenant, expect to have to pay those. Okay. And you also probably want to put some marketing costs there, $500 to $1,000 in marketing costs. Some people will put asset management fees of 3 to 6%. I don't necessarily do that. If you're going to be managing a list, if it's going to be rental portfolio, stuff like that, that may be something different. But I usually will just slap a little bit extra, 500 to 1,000 in marketing costs for getting things recorded, costs of your email, other things you do, the BPOs and stuff like that. You may want to roll that in there as well. Okay. Now, most important thing is to stay below 65% of as is as best you can. Don't get me going to 80, 85 cents of the dollar of value when funding that deal. It just starts to take away all the profit and it's kind of becomes a skinny deal. Stay that 70% of value of as is value, not after repair value. Okay. It makes you in a good position. Because there's always what you want to keep in mind when you're talking with investors is they're going to ask you what's protecting their investment. And these are the 5 things that we're only buying first lien. We're not buying a second lien. We're buying a first lien in the first lien position. The only thing that wipe us out will be God and taxes. Well, if we're going to pay the taxes, we're good. And then insurance, in case there's an act of God. We're buying at 70% of value of as is value or below. So we're always going to be in a good, we're making our own equity basically in the deal. We're using servicing companies, attorneys to collect and foreclose, do the professional heavy lifting. It's not me going out and trying to collect rent or collect payment. It's somebody who's licensed and has done thousands of these deals. As I said, insurance too. Force place insurance the borrower doesn't have in case of an act of God or stuff like that. We're protected, or an angry borrower. And then 5, we're always going to check title and the collateral files to make sure that we have the right. All our T's are crossed and our I's are dotted to make sure if we buy that note, we have the full right to foreclose, full right to modify. If for some reason that doesn't pass the smell test, we're going to kill the deal and move on. We're going to make sure all the paperwork is in order. And that's the great thing I love about notes, ladies and gentlemen. You can do your due diligence. If something pops up, value, collateral files missing, condition of the property doesn't look good, all right, or it's a trouble borrower, guess what? You're doing that on the front end. You can cancel your bid and walk away and not be penalized, okay? Great stuff when it comes to that. Hey, real estate investors, entrepreneurs, and business owners. My name is Scott Carson. I've been an entrepreneur for over 20 years and been a business owner just as long. And there is one must attend event that I think you should all attend to make sure that you are protecting your wealth or looking to grow your wealth. That event, when I talk about, that's Magnify Your Wealth. My friend Aaron Young and his whole team at Laughlin Associates puts on this event live and in person twice a year. And the next upcoming event is April 25th, 26th, and 7th in beautiful San Diego, California. And this is an amazing event that focuses on how to increase your cash flow, reduce your taxes, protect your assets, and also help you create a wealth plan for you, your family, and your business. Not only will you have the opportunity to learn about asset protection strategy, you'll actually have the opportunity to actually sit down with the speakers and help them go through your plan, help them create a plan that can help you grow or adjust your plan because everybody is different. Nowhere else are you going to be able to sit out with CPAs and fractional CEOs and accountants and estate planners and people that set up businesses for over 50,000 business owners out there on an annual basis besides Magnify Your Wealth. It's run by Laughlin Associates. Our friend Aaron Young does a great job. Trust me, it's one event you do not want to miss. It's a small, intimate event, about 100, 125 people. Megan Cole, Aaron Young do just an amazing job with the networking, the roundtables. It's a 3-day event. And it's usually in San Diego, sometimes on the East Coast, some in Denver, but check it out at magnifyyourwealth.com. Get signed up today by going to the website and hitting on reserve my seat. You will not regret it. It's at the beautiful Dana Resort, but April 25th, 26th, 27th, mark your calendars and reserve your seat. Every time we go, we walk away with new nuggets and ways to protect our hard-earned dollars, our wealth, and how to grow our wealth. It's an amazing event full of great people, a lot of high wealth, great place to raise capital, great way to meet other entrepreneurs that you can bounce ideas off of and go from there. So check it out, magnifyyourwealth.com. Tell them that Scott sent you, and they might just give you a discounted seat. Now, one of the most valuable sessions of Note Weekend, of this one-day class here, is this session, how to find investors. Raise your hand, give me a shout out there on the live stream, on YouTube, stuff like that, if this is one of the things that you are most interested in. And look, I was there. I didn't have a lot of money to go buy notes when I started off. I got down a couple bad rehabs. I was doing mortgages and made some money, but I didn't have enough money to go buy a 6-unit apartment complex in San Diego, right? We're all looking for money. Yep. Thank you, Mike. Appreciate it. We're all looking for money. And one of the things I think that helps us stand out from the noise out there is we literally will show you how to go find investors to fund your deals and what to say, what not to say. And finding investors is pretty easy to do. Yes, it is pretty easy to, especially if you have a deal. Now, if you don't have a deal, guess what? You share case studies and other types of deals that you've done in marketing, but go out and start networking in your local real estate investment clubs and meetup groups. You're in San Diego, California, Texas, Florida. There are tons of investment clubs to go to. Start going out networking. Go one night a week. Well, Scott, they don't focus on it. That's fine. You're going just to connect and start building you a database. All right. Jump on LinkedIn and start connecting with real estate investors. All right. Look for people that say investor, real estate investor, IRA investor. Start connecting with those people. Go into some of the different groups. Look at profiles in those groups. Go to Connected Investor. Go to Bigger Pockets and start searching for people that have posted like keywords that you can search for, like 50K to invest, 75K to invest, 100K to invest. And send those people your pitch deck video. Okay. Your 10-minute pitch deck video about what you're doing and the types of deals you're doing. It's simple to do. We've got people that raise millions and millions and millions of dollars by doing 2 or 3 things on a consistent basis. Okay. Go to self-directed IRA custodian events. If you're in California, there's a bunch out there. If you're in Florida, you're in Texas, start looking at your local IRA companies and do a search. Ultimate list of self-directed IRA investors to see all the companies that are available out there. And go start seeing what events they're doing, whether online or in person. But we like going to the county records. We go to Netra Online, and this is a website you're going to want to go save somewhere, netronline.com. This basically is a website that pulls in all the different county records websites all across the country and every state that you can go to and click on. Look at the tax assessor in, Hamilton County, Ohio, or here in Austin, Travis County, Texas. It's a tool that we use not only on the due diligence side, but we do it on the capital raising side, because we go to the county appraisal districts and the county clerk or the county recorder's office to search for people who have used either their IRA to buy a property or to lend money out of that, okay, to other investors. And the great thing is you can get a ton of stuff from just doing a couple searches looking for self-directed IRA custodians. So like if we go to the county appraisal districts, there's a whole bunch of different names of it, but like the biggest out there that you can search for is like Equity Trust. The second was Quest. Quest has been changed now. They've been bought by a different company, and that's okay. But if you go to like the appraisal district and you do an owner search, property owner search, don't search for like Bob Smith or Scott Carson or FBO for a benefit of. Actually type in owner names on the county appraisal and say like Equity Trust. Because if somebody uses their IRA to buy a piece of property, it's got to be titled Equity Trust FBO for the benefit of, account number 1234567 or Scott Carson IRA 1234567. Okay. So go search for that. You will find oftentimes hundreds and hundreds of people, depending on where you search. Now, if you're looking at a rural county, you may not see much, but if you go to major counties, you'll find something like Equity Trust is the biggest one. They're usually going to be somebody in every county that has something. Now, some counties will not allow you to search by name. Like in California, you can't do search by name. Sorry. It just is that the county appraisal district will not allow you to do this. Virginia won't allow you to do it. Maryland won't do it. Minnesota won't allow you to do it. But guess what? There's still plenty of other counties across the country allow for you to search. And they'll often give you a mailing address. Heck, some of the Ohio counties, you can actually download the mailing address in a mail merge file. So it's easy for you just to send a letter campaign, a postcard campaign. This is something that this is the only direct mail that we do is that to IRA investors. Okay. Pretty simple to do. And it turns into a great way because guess what? If I'm contacting an IRA investor, a self-directed IRA investor who's already used their IRA to buy a property, lend money out, guess what? They're educated. They've got money. They've pulled the trigger. And guess what? You don't have to teach them about investing in real estate. Plus, guess what? It's got to be passive. They're using their IRA. They understand the passivity of using that. And that's great for notes. Okay. And if we get a name, if it gives us the name, we don't see the mailing address in there, we'll go jump on White Pages or Spokio and skip trace them to find a mailing address, an email address, or even a phone number. In a lot of cases, you can do a drip campaign to them via email or a text message blast. Okay. And like I said, we'll mail a letter or postcard, or we'll even start reaching out and see if we can find them on LinkedIn or Facebook and stuff like that to connect with them that way. Now, the county clerk, this will allow you to do a deed search. Now, this will work all across the country. Okay. And a deed search is looking for somebody who's lent money out of their IRA on a property, right? Same thing. You go to the county clerk or the county recorder's office. You do a property type search, either a deed or release of lien. Same thing. Type in Equity Trust. That's the lender. It'll pull up a list of people of deeds. Click on the deeds. You'll see the mailing addresses and the person names. It's a little bit more intense to look at the deed search history than it is the appraisal district, but still very valuable. And you'll know exactly how much money those people have lent, plus the investor they lent it to. So it's kind of a 2-for-1. Same thing, mail a letter, postcard, skip trace and contact them on social media, and then rinse and repeat. Okay. Simple to do, easy to find, hundreds and hundreds and hundreds of investors that you reach out to. And honestly, ladies and gentlemen, you don't need a lot of people. 2/3 of all IRA investors have 150 grand or more in their account, in their IRA account, and they have other accounts. So all you need is about 6 to 10 people to raise $1 million in private capital in the next 90 days. Okay. Now you can also buy custom lists. You can go to do a search for, buy a list of IRA owners that are not specific to like a Equity Trust or a Quest Trust company. You can ask for them to those that have 150K or more and do it by a city, a state, or a county. You can purchase a list of employees. If somebody's working for Apple or Halliburton in Houston, stuff like that, you can actually buy a list of employees that have pretty good high 401ks. The list will usually include the name, email, mailing address, and sometimes a phone number. There's 2 services that we've used for stuff like this, Melissa Data and exactdata.com. Okay. Now you're going to get a big list because they are only going to charge you somewhere between 6 to 14 cents a lead, but they want usually a minimum order of $1,000. So you're talking, if it's at 6 cents a lead, that's about 16,000 plus names and contacts. Your hardest thing is going to be to import those into your CRM to market to. Okay. So a little bit each day, but it may be more valuable for you to do that to start that marketing aspect. Okay. Now, where can you post for deals? Post deals from your past experience, post deals that you're evaluating, post other deals that are friends. If you get a tape in, map the deal on batch geo. So, hey, I'm working on a tape here. We're evaluating these 20 assets, but never mention safe or guaranteed. Those are two words you never want to mention in your marketing. Say, hey, we're looking for somebody who's looking for an above average return or looking to make a flat 10% return on their money. Okay. Your short pitch deck video should include information about you, your focus, your company and team, your vendors, and the types of deals that you're doing. Okay. Now, qualifying investors is just important. As you're doing this outreach, not everybody's going to be a good fit for you. First thing, is part of why we like targeting self-directed IRA investors, is are they currently invested in real estate? What have they done? Are they accredited or sophisticated? How much are they looking to invest? You got to ask that question, because you may be dealing with somebody who's got, $500,000 versus $5,000. $5,000 is not going to do it for you. $500,000, okay, great. How long are they looking to invest? Now, when they start thinking about no investing, they're going to think 30 years. No. We're talking short term, 2 to 3 years. Okay. Get in and get out. If we buy the note and foreclose, we're going to sell it and be done in under 2 years usually. Are they active or passive as an investor? That'll determine the kind of returns they're looking for. If they've been an active fix and flipper making 10, 12%, guess what? They're going to have to make 10 or 12%. If they've been passive or haven't done anything, the money's been sitting in their IRA account for a year or two, and giving them an 8% return is a pretty good yield that they wouldn't be able to get themselves. Okay. We use an investment questionnaire. We provide that in our 3-day class to help you go through the questions that you ask people, help you guide the process to make it work. Okay. But there are investors that you want to avoid. People unfamiliar with note investing or unfamiliar with real estate altogether. People wanting a short-term or a higher ROI. Well, I only want to invest for 90 days. Well, you're not a fit. Or I want 20% return. Well, you're not a fit either. Okay. I avoid most of the time people below 50,000. They're just kind of a pain in the ass. All right. It's too small amount anyway for you, a real good deal. And then also pay attention. Look at people's social. What do they say? Who have you invested with? What have you deals? If they start talking bad about somebody else out there, they're suing them, they're probably going to end up talking bad about you too. And one of the things that we ask in the investment questionnaire is, hey, have you been involved in a lawsuit? Have you sued anybody? What's that situation? You're just as much investing your time and interviewing them as they are kind of talking with you. See if you're a good fit. Okay. Ask for references, past partners, CPA, attorney, banker. That's just important to ask that, as is they'll ask that of you as well too. Okay. Always require investors to fill out the investor profile questionnaire, send you a pledge letter or email, and that's pretty simple. Like, hey, Gene, can you send me a pledge letter, which includes a copy of your bank statement or your proof of funds from your IRA? I know there's 200,000 there. Just say in the email, hey, Scott, I'm attached my bank statement for my IRA. I'm pledging 50 grand of those funds towards you directly. Okay. Now, if they won't return these items, fill out the investment questionnaire, send you a pledge letter and a bank proof of funds, they're not going to fund. Okay. But if they're using a IRA, make sure it's with a true self-directed IRA custodian like a Quest or Trust. If it's with Schwab or AG Edwards or Chase Bank, they're not going to allow them to fund that deal into notes or real estate. Okay. If it's in mutual funds or stuff, it takes 3 days alone for that investor to trade out of those funds into cash and then transfer it over to their new account. So you got to really understand they could take a week or 2 weeks for somebody to move money around to get to work for you. So ask these questions on the front end and help guide them on their path to getting this deal done. Okay. This is important. Always have paperwork created by an attorney. Okay. Your funding agreement should be something that's definitely created. Allow a CPA or their attorney to review, but also make sure if they have questions, great. Ask them, are they invested in real estate? If they're not invested in real estate, an attorney can screw shit up faster than anything else out there. Okay. Always use agreements. But part of using the agreements and using your executive summary to create or pitch deck is to look more professional. If you look like ass, people are going to think you're going to invest like ass. Okay. Your agreement, no matter who it is, even if it's your mom or your uncle, it always outlines what happens when things go wrong. Most investors can't make 6% or greater in the market because they're too lazy to put it to work. Guess what? Don't give them more than that. Okay. If the money's making 0%, 6% is an above average return to them. Okay. I was always amazed when I was a banker. There were people that would move hundreds of thousands of dollars from one bank to another bank to make an 0.8% difference on a CD. Go from 4 to 4 1/8 or 4.5, 4 1/4. Understand that you have the gold. He who has the gold makes the rules. In this case, the gold is not the money. The gold is the actual deal flow. Okay. As far as payments and communication go, if you're making payments to people in their IRAs, just make it quarterly. Avoid the monthly thing. It becomes a kind of a pain in the ass paperwork wise, and then fees. So just do it once a quarter. Okay. Most of these people that are using their IRA aren't living on that money, and once a quarter with interest payments or waiting until the end of the deal, if it's a non-performing note, is fine by them. Set up a portal like Basecamp or Dropbox or something that you can help with the communication, just so that they see what's going on and you're communicating with them. Never pool money investors together. One investor per asset. If you need 3 investors to fund a deal, make those 3 investors go create an LLC together and you borrow money from the LLC. Okay. Now you can put your money with somebody else's money to go make things happen. Just gotta be careful about that. Okay. Make sure you structure it properly. All right. Trust your instincts. If somebody's a pain in the ass in the front end, they're going to be a real pain in the ass if the deal goes longer or something starts happening and it drags out longer. Okay. All right. Let's move on to marketing. Hey, real estate investors. My name is Scott Carson. I'm known across the country as the Note Guy. And as somebody who's been a real estate investor living in the Lone Star State for over 20 years now, I often get questions from people looking to invest in Texas, whether they live here in Texas or they live outside of the Lone Star State. Where do we find our distressed leads? Where do we find our foreclosure list? And the number one source is Roddy's List. This list has been around for 20 plus years. George Roddy over here, smiling face, is a friend, and his source for foreclosures on residential or commercial properties, the sheriff's list, the struck-off list, is second to none because it's just focused on Texas. And if you're looking for Texas deals, which is the fastest state to foreclose in, then you definitely want to check out Roddy's List. You can go to Foreclosure Listing Service, is what it's known for, flsonline.com. If you use the code WeCloseNotes, that's right, WeCloseNotes, it'll get you $20 off your order, whether you're ordering a foreclosure list in Dallas County or Harris County or Travis County or Bexar County, whatever county you're looking in or whatever source list you're trying to buy from them, that'll get you $20 off of the price. Can't beat that. It's a great resource. We use it all the time to find distressed notes, banks with bad debt, private investors who are foreclosing, private individuals who are foreclosing on assets, and also potential REOs for us to purchase or our students to buy. So make sure you check it out at flsonline.com. That's flsonline.com. or foreclosure.info as well. But make sure you tell them that Scott sent you. Use the discount code, once again, WeCloseNotes, to get your $20 off. So one of the things I said early on is I'm a huge fan of marketing to raise capital, marketing to find deals, marketing your business to get deals moved. We do probably the best job of anybody out there when it comes to marketing our note business. Okay. Marketing our podcast, marketing everything else out there. This is one thing I really enjoy. And this is one thing, guys, you don't have to be me to get things done. But you do have to embrace the marketing side and sharing what you're doing with your audience through a variety of different tactics. And every tactic's a little bit different. You don't have to do it all, but you do have to pick something and start doing something on a regular basis. If you're not marketing your business or sharing what you're doing with your audience, you're going to have a hard time raising capital. You're going to have a hard time finding new deal flow as well, too, for you. And once again, 80% of sales are made after the 5th contact. Okay. Expect to post to social media. Yes. Oh, I hate social media. I hate Facebook. I hate Twitter. I hate all the Trumps. I hate all the anti-Trumps, whatever it might be. Guess what? Go to LinkedIn then. Okay. Create you an email list. You got to post, start posting somewhere. And you need services like buffer.com or hootsuite.com to kind of automate the posting, scheduling, pre-writing it. Okay. 3 most important things to use in today's market is, one is an email CRM. Keep Black Book REI, our preferred vendors, sending an email blast out to your database on a weekly basis. Okay. LinkedIn, automating, connecting with asset managers or investors on LinkedIn on a daily basis. Okay. Video marketing, talking about the types of deals that you've done, deals you're doing, sharing what your knowledge is, sharing your pitch deck. You're going to use YouTube. All right. YouTube is now, I mean, it's always been the second largest search engine, but it's also the number 1 spot where people consume content. I mean, TikTok's okay, but those are often shorter video. Your longer form stuff on YouTube is where people go to search to find things out and to find you. Okay. Now, email marketing, email regularly, it's the number 1% ROI for marketing. Still get a 4,400% return for every dollar you spent. Okay. We mail out to our database Tuesday, Wednesday, Thursdays a lot of time. We email out usually on a Sunday night to our investor database as well too, with something that's coming up, a webinar or something like that. What do I talk about? It kind of is down into 4 different categories of the different things that we talk about in our emails once a week. And many people are thinking, like, once a week, I don't want to bother people. You're not bothering people if you're adding content. If you're adding quality information to them on your database, whether it's 10 people or 10,000, providing these kind of 4 nuggets along the way is going to help you out. Every month has a holiday. Okay. It is March right now. What do we have coming up? St. Patrick's Day, February, Valentine's Day. Okay. It's what, International Women's Month or Women's Week, something like that. Okay. Great. April Fools, Easter, May, Mother's Day, Memorial Day, June, Father's Day, July, 4th of July. Okay. August, what's this in August? It's I'll never forget what's going on in August. Well, it's like school, going back to school, stuff like that. September, Patriots Day, September 11th, you know what I mean? That kind of stuff. President's Day is over there somewhere. October's Halloween, November, Thanksgiving, December, Christmas, January, New Year's. You get what I'm saying? So sending out is just to say happy holidays or happy Kwanzaa, or that's 1 email a month you could send out. If you're networking in your local market and you start building contacts from your local market, put them in your database and then start inviting people out to your local meetup group, your local networking event. Hey, I'm going this week. This week I'm going to the local event. We're going to learn about this, this, and this. If you're interested in A, B, or C, hey, meet me ahead of time and I'll buy you a beer. Okay. Personal event, something fun. Hey, kids are graduating high school, graduating college. I traveled to New Orleans for the weekend. You know, just sharing what you're doing. People like to see what you're doing. They build rapport. They also like to see people taking action. Like, hey guys, we went and looked at this property this weekend that we're thinking we're buying to rehab it. We're buying this note. We drove by it to take a look at it. And then the same thing, past or present deals. If you flip property, do a drive-by photo. If you are working through a note deal or your friend is helping, go take a look at those things. People love to see that kind of stuff. I'll drive an hour and a half probably tomorrow to go look at this RV park on this note deal. Why buy it? I don't know. Maybe I will, maybe I won't. But it's all about the more you look at and the more you share, the more capital you're going to raise to make some things happen. Now, your bank asset manager is not going to email them weekly. You want them to keep them separate lists and email them, like I said, once or twice a month. But email marketing is something everybody should be doing. And this is always the spot where people fail. They completely fall flat in their face. Okay. Now, LinkedIn, everybody should have a LinkedIn profile, but you need to spend time on there. You need to update it, put a good headshot, a professional headshot, a banner, your LLC name. You don't need to put your whole profile as far as like your resume going back to when you were like a barista in college. Put some stuff on there and complete your profile 100%. It's really your business resume. It's really the last place where it's the first place to go to asset managers and go to look and check you out. Okay. It's also the easiest way to find investors and bankers on there by looking at job titles. We use octopuscrm.io to start that LinkedIn connection aspect of things. But don't be lazy on here. Spruce it up. Your about session on LinkedIn is one of the most important pieces of digital real estate for you to have out there to help people, for you to tell people what you're looking for. And only 3% of LinkedIn users post daily. Okay. And very few people post on the weekend. All right. If you just posted an article or an image of a property, you out looking at something or something like that, you're going to start seeing some engagement taking place. Okay. Join, and then also join some groups on there and post to the groups. That's an easy way to build your network as well. And you can import up to 1,000 contacts at a time. It's a little trickier to do that than it used to be. It used to be really easy to upload 1,000 emails and then send out invite requests to all of them. But now you got to go upload the list and select them all individually, which can be a bit of a pain. But anyway, it's still something to use. And yes, go ahead and pay for the upgraded version. You're going to have some marketing costs, guys. Cost for your CRM, cost for Octopus, like $20 a month, and other things you do. It's a cost of doing business, being in business. Now, video marketing. Here's where everybody wilts away, doesn't want to touch base with stuff. Like I said before, YouTube is the second largest search engine owned by the #1 search engine. You can post videos on there, and they'll often rank organically higher than paid advertising. So go out there. If you've got a deal in Austin or Jacksonville, Florida, or St. Louis, Missouri, go share it. St. Louis walkthrough, Round Rock walkthrough, whatever it might be. All right. We use a service called TubeBuddy to help us grow, but short videos under 3 minutes do really, really well. You know, it's 24 hours a day, 7 days a week, 365 and 1/4 days a year advertising for you. And yes, it's more than just uploading a video. You need a good description. You need a good thumbnail and put a link or two in there. But it adds so much value. Our biggest referral sources, our number one lead gen, ladies and gentlemen, two, one is YouTube. And the second one is our email stuff. Okay. Our podcast is right in there as number 2 or 3 as well. Okay. The reason we do so much stuff is it drives people into engagement. It's how we've built a database of 75,000 people. Okay. Now, I know that may sound something, but it started with me getting business cards and writing their name, their email, their address on a spreadsheet. When I started doing that back in 2002, 2003, 2004, that's where it all started. Was putting people on a spreadsheet. So I had some place I could just copy paste them into an email and send out. Now that's low school. I would not just copy people's name into your Yahoo or Gmail account. You need to go get your CRM and spend some time putting them up there. It looks more professional. Facebook, it's not. I mean, if you're going to upload a video to YouTube, you might as well share it to Facebook as well, but that's only going to last about 24 to 48 hours. Same thing with like TikTok. It may only last 24 to 40 hours unless it catches viral. LinkedIn Live, LinkedIn like small video, that actually works really well with short video and starts to add rapport to your audience as well. And guess what? If you've got a smartphone, an Android, or an iPhone, this is one of the most valuable pieces of technology you can use. It's great, best video camera out there, much better than like what we use, but it's included. Might as well use this. Use this to your effective advantage. Otherwise, you're in the dark ages. Okay. Now, the marketing octagon, we're a big believer that taking one piece of content, one image of a property can turn into a variety of facets by sharing it across multiple channels. Okay. You know, photos and stories do best. So if I'm going to drive by a property, like I drove by a couple properties in Georgetown and Leander, I took pictures of them. I made some offers on these notes. I'm waiting to hear back, but I've got a photo ready to rock and roll to share to start raising capital and talk about the deal. I'll upload that short video or that image to Buffer and schedule it to go out across my platforms throughout the week where I don't have to do it one at a time. Not everyone is on every platform. And it doesn't mean you need to go out there and share all the 25 best recipes for banana pudding. Okay. But sharing, hey, I've got a deal that I'm working on. If 5% of your network sees it, that's better than 0%. Okay. But if you share it on Facebook, maybe 1% sees it, maybe 5% sees it. If you share it on LinkedIn, guess what? You'll start getting some crossover and you'll have more people see. It's like going fishing. Would you rather just throw one line out in the water, or would you rather throw a cast net? A cast net's going to catch you more because it's cross per money. You're hitting more hits, more opportunities. And the best times to post are at lunch, 3 p.m., 7 p.m., and 9 p.m. works best if you're posting to social media, stuff like that. And just start with one thing and start sharing something. Start cross promoting. I mean, you use AI to so many great things out there to make some things happen for you. Okay, great. All right, everybody. So one thing that people ask me is, how do we structure? What entities can I buy notes? Can I buy my own name? Can I buy them an LLC? And then so yes, you can buy them any entity way you want to. I would not buy notes in your own name, though. We want to structure your note business like you're treating it as a business, not individual. Okay. You need to use LLCs, trusts, S corps as your buying entity. Okay. You want to protect yourself, your individual from your business. The two things: I am not the corporation. The corporation is not me. Okay. One of the most important things to do. I wouldn't keep more than $1 million in asset values in a single entity. Commercial, I keep commercial assets separately. All right. I'll give you an example. If you go to anybody goes snow skiing, or you go over to like Disneyland and you ride the gondola, right? Disneyland, where you're on a snow ski and you get the little gondola going up the mountain. Those companies, each gondola, each snow ski lift is its own separate LLC. So if somebody gets hurt on one of those and they sue, they're only going to get what is in an LLC. Basically, they own a gondola. Okay. Not the whole thing. That's asset protection. Now, I'm not telling you you need a separate LLC for every note. That doesn't make sense. Okay. That can be a bit of a paperwork nightmare. But like keeping your $1 million of value, if you're buying $100,000 notes, guess what? It's worth it at that point to spend the the $900 a year for Canada, in the communist state of California, or the $300 to create an LLC here in Texas. It's worth doing that as part of your equity entity and asset protection stuff. Okay. If you have an investor bring in $250K or more, so use a separate entity just for their stuff. Okay. You want to keep your deals, assets separate from partner deals, existing biz. You may want to have an LLC just for your performing notes. You may want to have an asset for your non-performing, for your rental properties. I have separate entities for my podcast, for my business, marketing business, my management company. As you grow assets and add deals and value to your estate, to your business, you're going to want to make sure and have asset protection included with it. Now, yes, if you have a self-directed IRA, can you buy in your self-directed IRA? You sure as hell can do it, okay? So, Mike asked a question, what's the $1 million cap in an entity based on? That's just based on me. Some people only want to do $500,000, okay? I would not be putting more than $1 million in there just because it's kind of the round number there. I'm going to start splitting stuff up. Because here's the thing. If you have an investor who's disgruntled in an LLC, okay, they lent you money and the deal drags out longer than expected, okay, and they get angry and sue you, well, they're going to sue that LLC. Guess what? Everything that's in that LLC is affected, okay? But spread your stuff out, all right? They can't go after 5 other LLCs that they're not involved with. That's part of doing it. You want to protect it. If you have a rental portfolio, somebody falls off your roof and breaks their back, the first thing the attorney's going to do is go look, see what kind of assets you own or that LLC owns. So if that LLC owns 20 properties worth $5 million, guess what? They're going to target it. If that LLC only owns 1 property, well, they're going to target that 1 property. And that's the thing you have to do. Okay. I would highly recommend you go watch the most recent podcast. One of the most recent podcast episodes we did with our good friend Aaron Young from Laughlin Associates. He break down a lot of the different things that to worry about as an LLC and as a business owner. Now, going back to, can you use your self-directed IRA to buy? You sure can. It's not smart, though, to fund in your own name your IRA, because then guess what? People can track you down. I'm not saying you can have a disgruntled borrower reach out to you if you're foreclosing, but I would rather them not know my home address, right? It's good for asset protection. The Consumer Finance Protection Bureau used to be around to target, if a borrower got in trouble or made, we've had this happen where a borrower made a fraudulent claim to the Consumer Finance Protection Bureau that we are basically foreclosing on them and have taken all their money. Okay. And the CFPB would check you out. Now, Consumer Financial Protection Bureau is gone. All right. But I would rather have them contact my LLC, not me personally. If they're going to slap a lien against me or fine me $50,000, I'd make sure it goes against the LLC and the assets in the LLC, not my personal name or my my IRA. You know what I mean? Some counties are suing trustees for back taxes, right? So like Quest got sued like 4 or 5 times because somebody who had an IRA and it's labeled Quest Trust for the benefit of, well, they didn't pay their back taxes. So what did the county of Wayne County do in Detroit? They sued Quest for non-payment of their property taxes. Well, Quest didn't have anything to do with that. They were just a representative. So now Quest was requiring people to create an IRA LLC if they're going to buy anything in Wayne County. Okay. Definitely, if you're using funding or joint venture partners, use separate LLCs. You can also do a self-directed IRA LLC and have checkbook access, which is kind of nice, which would be an LLC, not your IRA name. Keeps people from me like going out and tracking down who used their IRA. But that's what I'm saying. Use entities, okay? I would not recommend using a trust for the most part. I mean, trusts are pretty easy to create. And yes, you could do something like that with your performing stuff if you're going to hold it for a period of time. But if you're going to be moving assets or foreclosing, taking back, just put it in an LLC, all right? And get that done. You do need to document things in your LLC. Having an LLC is not just a trip to the Secretary of State's office and getting a tax EIN number. You need to document transactions, contracts, JVs, offices, vendors, partnerships. This is not trying to scare you out, and know your accountant isn't going to do this stuff for you. There's things that you need to document in your binder to make sure your LLC is correct. Issuing your own stock. You'd be surprised how many people have never done that, issue their own stock to themselves. That's why we like to use Laughlin Associates They've been around for 50 plus years, creating, helping people keep updated on their LLCs, helping them with their corporate veil protection, helping with their asset protection. We're very good friends with the whole team over there, and they do just a tremendous job working with our students and our clients and helping them set up corporate veil protection plans, asset management. They just do a tremendous job, and also host a couple events per year called the Magnify Your Wealth Summit. There's usually one in San Diego, and then the other time maybe in Denver or Florida. But if you go to magnifyyourwealth.com, it is well worth going to. The upcoming one is in April in San Diego. And you can go to laughlinusa.com to check out the products they use, or check out I would tell you to go watch the podcast episode with Aaron Young and myself from about episode 951. Go watch it. Great episode. Talks about what they do, what you need to keep in mind, and put that work to protect your assets. Okay. Questions about asset protection before we move on to exit strategies? Laughlin Associates works with about 95% of our one-on-one coaching students. They also, one of the great things is when you go to the Magnify Your Wealth Summit, you'll have an opportunity to sit down with all the experts you want, tax planners, CEOs, asset protection attorneys, trusts, and be able to pick people's brains and see what's a good fit for you or what's not a good fit for you. Free charge. That's included with your tuition, plus meals are provided. It's at a nice hotel. You got to get there, pay for your own room and board or your room, but they'll feed you good for breakfast and lunch, and breakfast and lunch. I think dinner's even included on Friday night. So well worth it in beautiful San Diego. All right. Hey, real estate note investors. This is Scott Carson, the note guy, and I've been an active real estate investor for over 20 years. And for the past 15 years, me and my students have relied on one company to help protect our assets and also help to create our LLCs and different entities and business formations and our asset protection to make sure that we're protected and aren't violating the corporate veil. What company is that? That's Laughlin and Associates here. They're out of Reno, Nevada. Huge fan of what they do and the customer service that they provide, not only me, but to my students, not only across the country, but across the world, especially for those looking to start businesses here in the United States, whether you're from Mexico, Canada, overseas. One company you want to reach out to is Laughlin and Associates. Aaron Young has owned this company for quite a few years. Laughlin has been around for over 50 years, and it's really the number one place for you to set up your LLCs through the Nevada LLCs or Wyoming or Delaware Limited Trust. They're just an amazing company to not only create your LLCs, but also follow up with the regular bookkeeping that you need to make sure that that corporate veil surrounds your business and keeps you safe from ne'er-do-wellers. All right. And like I said, I have been a huge fan of them. We've used them for every LLC, every entity we use, and they do just an amazing job in answering questions and helping to set up also our future, our estate, our Rockefeller plan, our asset protection plan, not only now, but as we evolve and grow more wealth and more assets. Laughlin Associates is always there to help answer our questions and help structure the things to keep our assets safe. Don't you want to keep everything you've worked for, whether it's your business, your real estate, your investment, safe and sound from the folks out there trying to take you down a notch? Well, make sure you talk to the team over at Laughlin Associates. You can schedule a free phone call at 1-800-648-0966. That's 1-800-648-0966. Tell them that Scott Carson sent you, and they'll take good care of you. Or check them out at laughlinusa.com. That's laughlinusa.com. Trust me, that's one phone call, one meeting you will never regret. All right, let's talk about exit strategies here when it comes to buying notes. How do you make money with a deal? And yes, there are different ways to skin a cat when it comes to note investing, okay? And some of these strategies that you'll do, sometimes they'll happen once in a blue moon, but you need to be aware of the different kind of waterfall event that takes place with exit strategies, okay? And this is going to be starting from the point you're buying a non-performing note, okay? Performing note, they're just going to keep paying, right? A monkey can collect. But what's important to know is when the shit hits the fan, what do you do when the borrower becomes non-performing, okay? And there's a longer note exit strategies webinar we've done. It's about an hour and a half. Go take a look at it. I mean, you can do a whole lot of things. We'll go through all these, what you can do. The first thing is obviously if you don't have to buy a note. You can wholesale a note if you want to, okay? Or just flipping contract, putting a note in a contract and flipping that paper. you're going to make the least amount of profit wholesaling a note. Okay, make a flat fee, give or take, 500 plus bucks per note or something like that. If it's a performing note and you're wholesaling it, expect to make 1%. Okay. If it's a non-performing note, maybe you make up to 3%. Okay. You may need to do a double contract or a double closing if you don't know the seller. I mean, if you don't know the buyer of your note and you don't want them to go direct to your seller, then you may want to do a double closing. Okay. If we're going to be wholesaling, we're always going to have the end buyer sign our fee agreement, with the loan sale agreement. And you may need to use an attorney as an escrow account to basically collect the funds from the buyer, wire the money to the seller, keep your commission separate. We'll do other things where it's just like a wholesaling agreement if I know that investor and trust them. But if you're dealing with somebody new, you probably want to do a double closing, and setting up an escrow account with an attorney is going to cost you $500 to $750. So keep that in mind. Okay. Now, good wholesalers know their deal and they know how to market it properly versus just, hey, check this out, check this out. Don't send out a spreadsheet that has the addresses removed. It's basically a sanitized tape. Nobody's going to buy off a sanitized tape, and it's a quick, easy way to tell that you're a joker broker. Okay. Now, if you actually do buy the note, what the hell do you do with it if you're not going to wholesale that deal? Well, guess what? The idea is to get the borrower to start paying. Your servicing company is going to reach out and ask them, can they start repaying the loan? And if they start paying on time and do it for 6 to 12 months, that's called a reperforming loan. But you're going to want to have a third-party servicer. You're not going to do the borrower outreach, ladies and gentlemen. Get you a servicing company. If you try to do it all yourself, you're going to screw this shit up. Okay, so pay the servicing company $25, $30 a month to collect on a performing note, or pay them $30 to $90 to collect on your non-performing note. It's well worth it. Okay, they're going to start collecting payments. They're going to send out statements to the borrower. They're going to do right party contact with the borrower outreach. Is what RPC stands for. And the servicer works for you. You tell them, like, listen, I'm willing to allow the borrower to start paying on time again if they'll make their existing P&I payment plus another double monthly payment, or if they bring $5,000 to the table, and go from there. We just had a student who bought a non-performing note. They hadn't paid in like 7 years. Okay, so they sent a demand letter out. Hey, you need to bring $41,000 to the table to stay in the house, or we're going to foreclose. Well, they sent in $7,000. That's not what the letter said. So the servicer was like, "Oh, we'll go ahead and accept the $7,000," and that doesn't make sense. It's not a good yield based on that. That's a lower interest rate. It might be good for year one, but not so good year 2, year 3. And my student's like, "Well, what do I do?" I was like, "Well, you demanded 41. They didn't pay 41. So cancel the $7,000 wire transfer, wire it back to them, and demand that they bring the 42 to the table." Now, the servicer's like, "Well, that's all wrong. How is it wrong?" No, it's not wrong. Borrower hasn't paid for years. They only have $7,000. I'm not going to allow them to stay in the property for $7,000. I have to worry about my investment. Okay. If the investors expect to make 12%, that's great. And it might be good the first year if they make payments on time again. If all they pay is $7,000, based on that first year, it's only an okay return. And it's not a very good return at all going after year one if they just start to make the monthly payment again. Okay. So you instruct the borrower. I always say don't do a modification. We do what's called a trial payment plan for 6 to 12 months. Okay. Or a forbearance. You put the forbearance agreement, put them back in the loan. But we're not going to modify. We're going to do some sort of trial payment plan before we go the whole route of modifying the loan. The reason for that is if you modify the loan and forgive debt, reduce interest rates, that stuff, it restarts that statute of limitations. So if they're 6 months behind, you can start the foreclosure process. Well, if you do a loan mod, no, you don't need to go get an originator. But if you actually do a mod, well, guess what? If they don't fall through the mod, you got to wait 90 days now, again, before they start, you foreclose. A trial payment plan, if they don't fall through on the payment plan, guess what? You foreclose. Okay? Nope. You're not going to fall through. We're going to foreclose. Okay? And you could do a variety with trial payment plan with lump sum or extra payments. Like I said, we do 12 months on these because it helps us make sure that deal is a long-term capital gains, not a short-term capital gains. But you can do a variety of things in a mod: adjust balance, forgive or reduce back payments, reduce the interest rate. Like I said, never go straight to a loan mod. Always do a trial payment plan and do that. Because if you do a loan mod, it restarts the time frame, and now you got to wait 90 days for the non-payment to start the foreclosure. You can always pause the foreclosure. Okay, and then restart it back up. Now, if they start paying on time and fall through, then okay, then adjust you modify it every 12 months. If they follow through and do what they're supposed to do, great. You got to enforce this with the servicer. Servicer works for you. You don't work for them. Okay. They could always do a payoff, pays off the loan, which is good. Or you do a short pay. Hey, you owe 55. If you can get me 45, I'll forgive you. We'll do it over 90 days too. If it's an owner occupant, ladies and gentlemen, if they're a primary residence, they're not going to be able to go get a bank loan. So if they tell you they're going to go get a bank loan or get a hard money loan, if it's their primary occupancy, it's not going to happen. So you have to call them on their BS. Okay. Now, if it's a second property or investment property, yeah, they could potentially get a hard money lender or an investor to come in and buy it. That's fine. Or if they sell the property, obviously they could pay you off that way too. But, pay attention, ask for updates on it and see where they're at. Or they could even, if they got a retirement account, they could cash out the retirement to pay you off. We've seen that happen before. You're going to want to handle your payoff through your servicing company. Pay a servicing company to handle this, even if it's non-paying. It's well worth the $35 a month for them to handle, making sure the statement's correct, it's Dodd-Frank compliant, all that good stuff. Okay. Now, if they don't pay you off, can they find somebody to take over the loan or assume the loan? You can allow a loan assumption. Okay. Every once in a while, we'll do this. Basically, allowing somebody to take over payments as is. Okay. Subject to the existing agreement. Okay. Maybe it's a family member, a friend, a potential investor. You need to fill out like a new qualification form if somebody's going to take it over, making sure that they can qualify. It's not creating a new loan. And we're not refinancing. If somebody wants to refinance into a new loan, no, go get requalified. Go get qualified somewhere. But what we want to do is make sure that the DTI is the same that's going to succeed, not fail. We're not refinancing. We're just wanting to make sure we got all the relevant contact information to contact the borrower. You're going to keep the existing payment terms, stuff like that. You're not going to forgive anything unless they bring a chunk to the table. And it's pretty easy. The borrower could just quick claim it, do a quick claim deed to the new investor and the new note payer. Pretty simple process, not too difficult to do a loan assumption. Okay. I don't get bent out of shape on the due on sale clause, right? Because when you buy the note, you're the bank. So if somebody deeds it to somebody else to start making payments, that's fine. Just what do we need to look for? Of course, if they can't do a payoff, they don't have somebody else to take it over, and they're upside down, you could always do a short sale. The borrower sells the property at an amount below your payoff. That's what they're shorting, is the loan amount. You, the lender, has to approve the short, how much is forgiven. I always tell, if a borrower approaches me and would like to do a short sale, first of all, what do they owe? What's the property worth? If they're way upside down, okay, great. Do you have an agent? If you have an agent, then your agent needs to list this at 85% of the fair market value. If they go and list it at full value, you need to fire that effing agent, okay? The agent isn't going to list it. Some of these agents are going to list it at full value. They want to get full commission. Well, if buyers see that it's a third-party required or short sale, they're not going to pay 100%. But if you have them listed to 85, then they're going to see there's a little bit of equity. They may be willing to wait out longer, 90 days for it. And there may be a multiple offer situation where it gets bid up to 90, 95, where you're taking less of a short. You're also doing it at 85 to see if there be any foot traffic or viewings. If there's no foot traffic or viewings, then you don't need to do a short sale. Then you need to do just a straight up deed in lieu, cash for keys, and go from there. But you'll also want to make sure that the realtor is not dragging this out. Okay. Also, making sure that the booking appointments are not around the borrower schedule, that they're available at any time. Okay. And yes, you at the bank can't have the ability to reduce it from a 6% to 4% commission. If I'm going to bleed, everybody's going to bleed. Okay. If there's no showings in 2 weeks, like I say, listen, let's move to a deed in lieu cash for keys where you can walk away from the property. Let's get you out in 30 days so that we avoid foreclosing on you. And yes, you can, whatever you take a short on, you can 1099 the borrower for the short to write off. Okay. Deed in lieu, cash for keys. Very simple. It sounds like it sounds. If instead of foreclosing, you let the borrower walk scot-free, you give them some money. Usually my cash for keys is the amount it's going to take me to foreclose. Like, listen, especially like here in Texas, I'll give you $2-3 grand to walk. Now, if they got a ton of equity, I might give them more. So I make more money instead of foreclosing at the auction and not being guaranteed to get all that extra equity. So the borrower then in that case signs a deed and you deeds it back to the property. You then, once you go record that deed back to you, you then file what's called the release of lien. This is the forgiveness of debt, and they walk away, and now you own the property. It's an REO. We've done it before with people like, hey, we'll give you $4 grand to do a deed in lieu. We'll give you $1 grand to sign, and we'll give the remainder when you're out in 30 days and the property's clean. Well, I had that happen one time. The guy didn't clean. He was still living in the property 30 days later. He didn't get his money. We then, in that case where he didn't want to get out, we went and filed eviction papers. He was out the next day. He moved out, but he didn't get his cash because he didn't do as he followed through on. All right. We want them to make sure that it's clean swept. But the great thing about doing a deed in lieu and a release of the lien, and it avoids a foreclosure on their credit that would haunt them for 7 years. And they're going to show some late pays from beforehand, or if you're reporting to the credit, you have the right to not report it to credit if you don't want to. Okay. It costs like $8 extra per month to report it to the credit bureaus from your servicer. So that's something to think. It's like, listen, if you do a deed in lieu with me, we'll give you some cash, get you out of here, leave that property clean swept. We'll avoid a foreclosure in your credit. In 2 years, you're paying bills on time. You could go out and get refinanced or get financed again for a mortgage. Okay. The big thing you always want is to run title, make sure there's no other liens on the property above yours. If you take a deed in lieu, cash for keys back, and you do a release of lien, if you're using investor money, or even not, if you're even using your own money, go slap a lien on the property after you've done a release of lien to securitize your investment or your investor's money, so that you don't have people go. There are some people that will go around there and slap fraudulent liens on properties all the time. Okay. Now, if there is a second on the property, second lien, go do a consent to judgment. Cash for consent, as we call that. That shows the judge that you can finish the foreclosure. It helps speed up the foreclosing and wiping out any second behind you. Okay. Always pull title. And if you're not there locally, make sure your realtor goes out and takes photos of the property, walk through, so you know what kind of condition it is. You may not want to do a deed in lieu. You may want to foreclose and try to sell at the auction if it's in bad shape. But it's also important for you to know what kind of condition it's in if you're doing a deed in lieu, cash or keys. Okay. Especially when it comes to forced place insurance. Now, you could always, if you didn't want to take it to foreclosure, you could turn around and sell it to another investor. If you've got a borrower that's dragging things out, a little bit pain in the ass, and you bought it cheap enough, turn around and just sell it to another investor at a markup. Okay. You have created value knowing which way to go. And here's the thing, a lot of funds that buy portfolios and non-performing notes, they work the first 90 days to get the borrowers back on track, making some sort of payment plan, getting back on track. And if they bought it at 50 cents on the dollar, and they know that they got half their portfolio back on track, the other half, they'll turn around and try to sell it off at a 10, 20% markup. Because they can make a 10% markup in 120 days. That's a 30% annualized return if they can move their portfolio relatively quick, okay? Or if somebody doesn't mind hanging around for longer foreclosures in a state like New York or New Jersey, let them handle it, and you make a quick profit and move out. Okay. In that case, sell to your local investors. You want to market it to your local realtors that, hey, there's something you're gonna have to hang on to, or turn it into a handyman special with a vacant property, move on from there. Okay. But find you investor-friendly realtor. How do you find those? Go to the local real estate clubs, find somebody there locally who's investor friendly, understands that it's a little bit different aspect. Okay. It's different than just calling, because a lot of realtors have dealt with investors like, oh, I'm going to send out 20 to 30 offers and REOs, and that's a big waste of time. If you've got a property, a note that you own, that's a different story versus potentially making offers. Okay. Of course, if the borrowers won't play ball, you don't have somebody they can sell the asset to, then you go the foreclosure route. Okay. We talked previously about this in the morning about licensing and stuff like that. In a non-judicial foreclosure, it's faster, cheaper. Like here in Texas, we could do it for about $1,000. Judicial foreclosure, it's a longer going through the court system. That could be 6 months to 3 years in some cases. You're going to spend a minimum probably $2,500 on judicial foreclosure, if not more. Okay. You're going to have the right to sell it at the foreclosure auction. So understand what's owed. Talk with your realtors to see what's happening. Sometimes if you can sell it at the foreclosure auction and make money, that's better than having to take the property back, fix it up, and sell it off. So if you're way upside down and you don't want to own the property, well, don't make it a full legal balance. Start the bidding at 60, 70% and see what it goes up to and walk away. Now, if you want to own the property, then do a full legal balance, especially if it's upside down, then you'll take the property back. If there is equity, do full legal balance and see if it sells above what you're owed. And if it does, you'll get paid full payoff, but any money that is bid above what you're owed will go either to a second lien holder or go back to the bar. Now, if it sells for exactly what you owe, or it doesn't, if it sells for exactly what you owe, you get paid off and walk away, minus any taxes owed. If it doesn't sell at auction, you'll do what's called a credit bid. Your attorney will put the bid in, and then you end up taking it back. Now you own the property. Now, if there is equity, you now own that property. It's a good thing. Okay. Like I said, bidding instructions, your attorney will ask for that usually the week of the auction. Make sure to touch base with them, let them know what's going on. You know, you need to dictate to them what kind of number you're looking to let it go at. Okay. Like I said, if you take it, if it's not sold, you take it back and do whatever you want with it. The foreclosure basically cleans the title and wipes out any other liens against the property. Now, of course, like I said, make sure if you take it back as an REO, make sure to place a lien on the property for asset protection to protect your equity. Now, you can also remember earlier on, we talked about how if you buy a non-performing note and get it reperforming, that's a good thing. You've increased the value. You can sell your reperforming portfolio. So like we've got a portfolio, about 20 notes that one of our students bought. He bought them non-performing, got them back on track. They've been performing now for over 12 months. He could sell them now for 80 cents on the dollar probably. All right. So he bought them at 50, sell it at 80. That's a pretty good market plus cash flow for the last 2 years. Okay. Of course, you're going to want to have a third-party servicing company to help handle that to make sure that the payments have gone through. You can only sell it off of P&I. So if you're doing it the first 12 months and your borrower is making 250 extra, you can't sell the cash flow based on what's come in already or the, you know, what the extra is going to be for 2 months. Sell it off of what the base P&I is. All right. Or what the base UPB. Can't sell it off the legal balance for the most part. Okay. That's the thing to keep in mind. Borrower may still be behind. Maybe they were behind for 2 years and they made 12 months payments. They're still technically a year behind, but that's still they're getting back on track. That's a good thing. Okay. Number 11 is bankruptcy loans. You know, BK loans are not something to be scared about. If a borrower files bankruptcy, it's a good thing. Most servicing companies, you'll need your own BK attorney, but most servicing companies have one to help represent them. And that's great. Now you have an attorney to talk to an attorney. And in a BK, the borrower's got to file a BK plan, which is about a 9-page disclosure of everything they own, everything they owe. And you can really see what's going on. In a BK Chapter 13, that's going to turn into basically kind of a payment plan for 5 years. Okay, so whatever they're behind on, usually the pretty common thing is whatever they're behind on, divide that by 5 years or 60 months, and that's what they're going to be paying extra on top of the existing P&I payment. Okay. Of course, if it's a small, if they owe a huge amount and, you know, like say they haven't paid in a long time, they're way behind, and that payment doesn't make sense, you can only say, no, this doesn't make sense. Let's just kick it out and we'll finish the foreclosure. Okay. But you want to go to pacer.gov and download the report and take a look at. Usually your servicing company or the seller that owns it will have a copy of that if you're buying a BK loan. Okay. You have the right to not approve the payment plan if it's bad. If they stop making the payment plan, guess what? You can ask for it to be kicked out and then finish the foreclosure. There are firms out there that are looking to buy BK Chapter 13 performings, you know, and they'll pay somewhere between 80 and 90% of the UPB. So that's something to keep in mind. And like I said, they don't follow through the plan, you restart the foreclosure and foreclose them out. A BK Chapter 7 is liquidation. Doesn't mean they get to own the property. It becomes basically an REO where you finish the foreclosure and sell it all off, or you do a deed in lieu of foreclosure. The bar does, you know, deed in lieu or foreclose, the bar does not comply. Okay. So it's kind of a rainfall effect. You know, hey, when I buy a bunch of notes, we'll notify the servicer, hey, here's what we want with these 10, these 10, and these 10, or here's the different A, B, or C plans that we offer up. You know, one of the things that we do a little bit differently is we send our own hello letters when a note is sold. Usually the seller servicing company will send out what's called a goodbye letter in the first 30 days, letting the borrower know, hey, we're no longer your servicer. You're now going to contact these people and not pay them, right? Our servicing company will send out its own hello letter, say, hey, thanks for not paying them, but now you need to pay us. Well, we do, like I said, we do one thing. In 7 days of funding, we'll go out and send our own hello letter out, knowing them that, hey, you bought from this company. Well, we now bought it. Now you're going to pay this company. Expect a letter from them. And here's what you owe. If you want to stay in your house, please contact us immediately so that we can keep you in there. Otherwise, we're going to start the foreclosure process and finish it up. Okay? Great. Hey, real estate investors, this is Scott Carson. I'm known across the country as the Note Guy, and I've been an active note investor focused primarily on the niche of non-performing notes, distressed mortgage notes on residential commercial properties for almost 20 years now. My company is WeCloseNotes.com. And I know there's a lot of different things when it comes to the note world. Are you buying performing notes? Are you buying owner finance notes? Are you buying institutional debt like I would focus on? Are you buying first, seconds, contract for deeds? There's a lot of questions. And it can be very confusing about what you can or cannot do. So one of the great things that we've hosted for the last couple of years that we do on just about a regular monthly basis is we host our one-day class called Note Weekend. If you go to noteweekend.com, you can register for our free 3.5-hour class. We'll talk to you and share with you how you find, fund, and flip non-performing notes. And yes, you can buy non-performing notes from banks, hedge funds, and a variety of different hard money lenders out there for your own portfolio. No, you don't have to have millions of dollars to dive into the non-performing note game. We've got students that have bought plenty of deals with 25, 30 grand, getting their ball rolling, using their self-directed IRA, who are tired of dealing with toilets, tenants, trash chests, tired of battling contractors and GCs to get properties rehabbed. We all know the market is changing. And while it may not be like 2008, 9, and 10 again, we do see a lot of distressed debt out there on both the residential and the commercial side. So if you're thinking about diving into the note game, becoming a note investor, a lien lord, as you like to say, versus a landlord, or you just want to figure out what it is about the sexy side of real estate in the note space, well, check it out, noteweekend.com. Doesn't cost you anything. We host it live, usually the first or second Saturday of each month. You can go today, register at the website, noteweekend.com. Register for the next live class we host. You'll get sent a replay to the previous class so you can start learning about the note business today. No questions asked, no credit card needed. This is a great way for you to dip your toes in the water and see if it's warm, because I guarantee going through our one-day class, you want to dive into the deep end and become a note investor. So check it out, noteweekend.com. You can also go to our website, weclosenotes.com. Check out our podcast. Check out our #1 YouTube channel. We are here to help support you. Whether you're an experienced investor or you're brand new to investing, Note Weekend is a great place for you to get the ball rolling. People often say we cover more in our 3-hour class than most people cover in their 3-day class. So check it out. Love to have you be part of our Note family. But get signed up today at noteweekend.com. Thanks and have a great day. All right. We've talked about a lot of different things so far this morning on some of the different things you got to worry about. Notes, just like anything else, other niche out there. And we put this session in here a while back talking about, is it a deal or a dud? And to discuss some of the things that you want to look at. And we kind of, it was a brain dump kind of talking about, hey, here's what you look at. If this is good, this is bad. And every deal is going to have a little bit of difference. And this is not meant to scare you. It's just meant to understand what's going on with that deal. Things to consider before buying. You know, when you buy the note, you should, part of your due diligence before funding is to get a copy of the servicing note. So you can see the transaction history. You can see what has happened, what the servicer is saying, what the borrower is saying when they call in, that kind of stuff. Look at the payment history. If they made payments in the last 24 months, what happened? Caused them to stop. If they were behind before COVID and they're still behind, foreclose. They had every opportunity. You know what I mean? If they went through COVID and then something's happened in the last 2 years, you know, we'll give them an opportunity to get back on track. Okay. Look at the market values. Are they going up or are they going down? You know, a lot of areas, the market values are going down because people are having to drop their values and trying to sell a property to get it sold. So it's causing the values to drop down. So just keep that in mind. Look at the days on market. This is a very important thing, especially in places like Florida. You know, if it's over 180 days on market, well, your value is going to be reduced by that amount, not going up. So make sure, especially if it's an old BPO that a seller is providing, make sure you pull your own and look at the days on market. Does it need repairs? Every property is going to need some sort of repair if you end up taking it back. So look at the external condition. All right. Be prepared. You're probably going to have to paint carpet if you take it back. Change the locks. There's a little bit of some stuff. Landscaping. Okay. Look at the foreclosure time frame. What's going on in that state? How long is the foreclosure time frame? Like New Jersey has a bad rep of it taking 2 years to foreclose on an occupied asset, but if it's a vacant property, you can expedite that in like 6 months. That's not so bad if it's vacant, okay? Look at the neighborhood variables. Is it in a good area? Is it a rough area? Is it in gangland? All right. Look at your zoning violations and issues. Contact the code enforcement department to see what's going on with it. Are things going to change? Are they trying to put a homeless hotel down the end of the street? Okay. Look at the city government issues. Like here in Austin, they're starting to do all this construction downtown. Well, if I was buying something downtown, you're going to have a lot of issues in construction. It may not be a desirable thing. Crime map. Chicago, Gary, where is it in a good area or is it a bad area? And we talked about the size and population of the city. This is important to know. If it's a small city, probably kick it out. Look at the exterior condition of the asset. Look at the current, like we're not going to send somebody out to look at the property immediately until our bid's accepted. So you're going to use Zillow, Trulia photos, previous listings, see what kind of condition the property is in. If you can, drive by it. If it's within an hour, drive by it. Why not? Okay. But always when you do, if your bid is accepted, always send somebody out to inspect it before you fund. Okay. If it's out rural, what's going on? Is it way the heck outside of town? Is it on acreage? That kind of stuff. And then I also like to see if it is in a smaller town, okay, is there a college nearby? That will add value to it. Okay. If it's in a major city with a major college, how far is it from the university, the main university? Okay, that can add value to it being close. Now, you also want to make sure that your asset meets your strategy. Like if you're looking for cash flow, you can achieve this by buying performing or reperforming notes. If you're looking for larger checks, you'll see that with deed and liens or cash for keys, or selling the property at a foreclosure auction, or selling it as an REO afterwards. Okay. If you're looking to add assets, you can do that with performing notes, or potentially if you've got you're buying assets or own assets in cities where there's plenty of inventory, it could add to your rental portfolio. I'm not a big fan of rentals. I'm not a big fan of taking assets back and then putting new notes or owner financing them, because it ties up so much equity for a period of time. Some people are, and that's fine. Okay. You always want to avoid weird assets and unfinished projects. Unless you're an expert in that, just stick to vanilla, steak and potato type of deals. Okay. And I'm a big proponent that the assets got to have 3 profitable strategies for me taking down. There's an exception to that. Okay. If it's occupied and I'm buying the note and there's the opportunity that the bar can get back on track, a reasonable opportunity, like if they're only 6 months behind, I got to make damn sure if they start making payments, that it starts reperforming, that this is going to be a good a good yield to me and my investor. If it's going to be a low ROI based on the price that I'm buying it at, don't do the deal. Surprisingly, 6 months of payments is not too hard for people to come up with to avoid a foreclosure in some cases. Does it make sense to do deed in lieu, cash for keys? Yep, it's got to be a must for that too. And if I'm going to take the property back and sell it, it's got to make profit to be a good time, not so many repairs. Of course, you don't know what the interior report's going to be on a lot of these properties. That's why you pay for forced play insurance. So if you buy an asset and open the doors, there's mold, there's no way for you to see it, your insurance company will cover that. If it's missing a roof, though, they're not going to cover that. You know what I'm saying? So those 3 things. Does it make sense as a reperformer? Is it going to make sense if I get a deed in lieu and expedite this in under 6 months? Or if I do have to foreclose and it takes a year, is it going to make sense to buy it, foreclose, and resell it? Rental or new note origination, that's up to you. I don't really like those for the most part. I don't want to create another job for me. If you're getting out of rentals, don't add rentals to your portfolio. Okay. Has the legal started? Ask to speak to the attorney, or ask to see the attorney notes on where they're at. What kind of time frame are they giving? Okay. Look at the collateral file, hardship letters, the background of the bar, the BK report. Okay. Those are all tell you, where the bar was leaning towards. Okay. Look at the state statute of limitations for debt collections if it's beyond like 4 or 6 years. Some of these hedge funds out there will say, oh, this legal balance bar isn't paid in 10 years. Well, if the state statute is only 4 years in that state, or 6 years, you can't collect the full 10 years. The legal balance is not accurate. So you can only collect on the most recent 6 years, not the full 10 years, if you know what I mean. Okay. Also, if it's in a state like Florida has safe harbor, where there's a lot of HOA liens and stuff like that, what's the process if you foreclose? How much are you going to owe the HOA? You're not going to usually own the full amount, but a payment, maybe it's 1 year of HOA fees or 1% of the original sales price. And that's an important thing to count. When you look in Florida, buying notes in Florida is not a bad thing. You just got to understand insurance costs, but also your safe harbor laws, okay, and how to avoid violating that so you're not stuck at the hook for everything. Okay. Questions before we move into more of the due diligence side of things? All right, let's dive into note due diligence. This is kind of a basic outline of some of the different things you got to look at for due diligence. Okay, now we talked a little about some of the things beforehand, but when you're buying notes, you're really doing due diligence on 3 different things: the borrower, okay, the property, and the collateral file. All 3 things are important to make sure you're buying a deal and not a dud. Okay. And we did a longer video by going to this link, bit.ly/note due diligence, to go and watch the longer breakdown of the full due diligence in our longer due diligence spreadsheet or checklist, I should say. So you're going to look at borrower due diligence. You're going to look at servicing notes. So have they been responsive? Has there been a right party contract, or have they been a trouble or pain he has to deal with? Look at the previous loan documents. What did they say they had as assets when they took the loan out? If it's a BK, look at the PACER reports. I always like this social sleuth, pull a skip trace on white pages or spokeo.com to find current phone numbers, current email addresses. Now, you can't call the borrower before you own the note and say, hey, would you be willing to modify? That's false. But you can call the borrower. I call the borrower all the time and say, hey, I'm looking for, are you the Jim Jones from Ingleside, Texas? Is this Jim Jones? Yes, this is Jim Jones. Oh, I'm looking for the Jim Jones that went to Ingleside. Well, this is not the wrong guy. I apologize. Hang up. Well, I know it's Jim Jones. I know it's a working number. That's what I do to that. Check it out. Of course, you can always have realtors go by, knock on, hey, would you be interested in selling your house like they do? It's a bit of an idea to see what kind of condition it might be. There's some gray area there. Okay, don't send somebody over to go take pictures and walk down the driveway. They could get shot that way. Okay. We do go to Facebook. We go to LinkedIn to social sleuth and see what they're saying on there, and you'll see some interesting things from time to time. On properties, we'll look at neighbors. If it's a multifamily, we'll actually look for phone numbers of the tenants. Call the tenants and say, hey, would you have the management office? We're trying to reach them. We're looking at potentially buying the property. Would love to get your take on it. Okay. Next door neighbor, especially when the house is vacant, call the next door neighbor. Hey, do you have a contact number or anybody to reach out to for that property? Is it secured? They'll know. Oh no, the back door is wide open or it's trashed out. Okay. If it's occupied, we'll call past or present employers. They're still working for you. See if they're making money. The property, that's obviously values as is, versus a 30-day quick sale price. We don't deal with ARV. Okay. Forget ARV. You're going to base most of your stuff off of exterior conditions. Okay. Realize that, you're going to put paint and carpet. And this is hard for some people come from the fix and flip side. Well, I can't make an offer unless I know exactly what's going to happen. If somebody's living in the property, most of the time they're going to take pretty good care of it. Okay. Paint carpet, maybe some updating, but that's light. Yes, occasionally you have the hoarder, but guess what? Hoarder is not so bad as long as you're buying at the right price. Okay. Look at the market conditions. Always put eyes on the asset before funding. Make sure it's the right asset. Check out recent nearby sales and comps. You're going to look at title report of the property too to make sure there's not any liens outstanding. You're going to get check the taxes to see what's owed, make sure and call to make sure there's not a pending tax sale. You're going to look at code enforcement liens. That'll help you too by pulling titles, see what kind of liens are on the property. Neighborhood activities, is it a good area or a bad neighborhood? Has it been listed on the MLS before recently, or has it been a rental property? We've seen this happen before. We see a property was an Airbnb. We got a whole interior inspection report basically of it, or see what it was rented, trying to rent it out a few months back. Okay, look at the rent rates. That's important. If you can't sell, it's still good to know what the rent rate is, just in case you have to do that. Look at your HOA or condo association limitations. In Florida, you have a lot of 55 plus communities where you can't rent it. Some cities won't allow you to do like Airbnbs or stuff like that. So keep that in mind as well. Especially in some of the condos and HOAs, make sure there's not any special assessments. You may have to call the HOA to find out, are there any special assessments? That's what's killing a lot of the HOAs and condo associations of Florida right now, are these six-figure and $10,000, $20,000 special assessments to get caught back up. And of course, crime maps. Is it in a good part of town or is it in a bad part of town? Right. Also, with the property, you will not get internal access. So unless the property's been listed for sale, if it's currently listed for sale, great. Go pull photos, send your realtor out to go see it. Okay. You're going to use Zillow values or Trulia values for values in the upfront due diligence. Once your bid is accepted and it's under contract, then you'll order a BPO, a broker price opinion, once it's under contract. Don't order that beforehand. Okay. You can use an automated online tool like NARRPR.com. That's free if you're a realtor. This is your guidance. If they give you a Zillow value, trust the Zillow value, but verify it. If the value comes back below what they say, then tell them, hey, your value came back. It's only worth 100, not 150. I'm going to fade my bid by 30%. And if they won't allow you to fade your bid, then just cancel the deal and move on. Call your utility department, especially in cities like Chicago, Baltimore, stuff like that. I call them. Well, I call all the utility departments. If somebody on staff call the utility department, see if power is on, see if gas is on. If it's off, that's an important thing. And then is there any existing balance on that would need to be paid because we're the bank? And the utility departments will take because you have got a vested interest. Hey, I represent the lender. Okay. Like I said, if the value comes back or taxes come back higher, things like that, refade your bid or walk away from it. Okay. But always, once again, always put eyes on the asset. The collateral file, that's what you're really buying. It's not the property. The collateral file is the collateral for the property, basically secures the ability for the IOU to be paid. You want to make sure you got the original loan documents, the original mortgage, the chain of assignment. So if the note's been sold 3 or 4 times, you want to make sure there's an assignment of mortgage for each one of those. You can check the county records to see that. If you pulled a title update, title report, it should show what's been filed in the county. So make sure that matches up. If you don't see a lot of assignments filed, then you want to check the collateral file and make sure there's a copy of those and find out why those have not been recorded. There's also an allonge that goes with every assignment that does not need to be recorded, but make sure you have an allonge for every assignment. Make sure to check out the deed of trust. Look at the previous appraisal that's in there. That's a bonus. The previous 1003, the loan, that's the loan docs. That's great. You want to have that in there as well. When you buy owner finance notes, you're not going to see probably the borrow 1003. You may not see the financial documents. You got to ask for that stuff. Like I had one guy who was trying to sell an owner finance note and he used a rental portfolio software. Well, all of his information was gone. I was like, well, do you have the social security number? Well, no. No. Do you have what he made? No, I don't have any of that. Well, that just reduced the value of that note. That's what people don't, they slap together owner finance notes like on a piece of paper or a napkin. That's not a quality piece of paper. You want to create your paper to look like bank paper. That's more valuable that way. Okay. You want to look at soft versus hard collateral files. A soft file is a PDF copy, a scanned copy of the collateral file that they'll send you. Before funding. If they won't send that to you, you do not fund. People are like, oh, you'll get that afterwards. No, no, no. I'm not funding. I want to see the collateral file ahead of time. Okay. Very important. Any questions about that before we move on to our vendor team, ladies and gentlemen? All right, let's move on. All right, one of the great things that I love about the note business is that it is a very vendor-driven business. You don't have to be a jack of all trades to get things done. Of course, if you're flipping property, guess what? They want you to go out there and handle contractors. You're trying to do the work yourselves. That's not a good thing to do. You need vendors as a note investor, and these guys and gals are here to help you take your business to the next level. Your trusted team is going to consist of your servicing company. Yes, you need a servicing company for all your notes. I had an investor who bought a note recently up in Massachusetts. They've had it for a year trying to foreclose. No servicing company involved in it, which they bought it from a bank. And now the bank and probate is asking for like a legal payoff, a statement. And she's like, I don't have one. I was like, well, you're gonna have to create one. So if you had to sit with a servicing company, it would have solved all that. Okay. And there are vendors out there, companies out there that will start you off when you're a brand new investor to allow you to do the one-offs, like the Madison Managements, the Allied Servicing, the FCI Lender Service. Actually, Allied really doesn't want to do small portfolios anymore. You could use like SN Servicing. There's a bunch of other smaller servicing companies that will deal with one-off investors, I'm sorry, Covey. Allied actually still does. I don't know why I thought for a second Covey was there. Covey doesn't want to do it, but FCI is kind of crap. It's hard to get anybody on the hold there. Madison's pretty good. Allied's better. There's Land Home Financial and other stuff like that too for you. SN's going to be the most expensive for the most part out of your smaller servicing companies. You need a vendor to pull title reports, O&E reports for you. You can use like a company like Baldwin Advisory Group. They're kind of a little slower these days. You can also use Pro Title USA, and there's also a couple other companies to help you pull reports. Our vendors are always constantly changing, so feel free if you're trying to pull something, reach out to me directly, and we can put you in the right path. Obviously, you need a valuation and BPO company. Baldwin Advisory Group does a good job with that. They've also got some other vendors. You can also, if you've got a realtor, reach out to your local realtor to get a comp pulled, to drive by the property, pull a good comp. Foreclosure attorneys, your servicing company should have that. A list of attorneys they work with. If you also ask for referrals from other investors, or worst case, go to legalleague100.com and find a company in the state that you're looking to do business with. Okay. But our best bet is going to be referrals and servicing companies for the most part. Okay. If there is an attorney handling the foreclosure, a lot of times you can retain counsel with that attorney so that they finish the foreclosure process so there's not a delay in the file being transferred. Okay. You may want to hire, if you're doing non-performing, a special servicing company that does heavy outreach. Singer Law Group's a company out of California we've used for years, a few others out there that do a lot of outreach for when you're buying portfolios of non-performing notes. They usually want you to have a minimum number of loans of like 20 to 100. Otherwise, you're going to be forced to board your note with a servicing company and rely on them to do their outreach for you for about once a month. So you may want to get a little bit more involved to hire somebody to help you. We actually brought in in-house counsel. Well, not in-house counsel, sorry, let me rephrase that. In-house special servicing gal who used to work for a servicing company to handle our assets, and that helped out a lot better. Okay, she was much more aggressive than waiting for the servicing company to answer. Okay. Your trusted team also is going to continue to include people to review your collateral files and actually store your files if you want to. You can use a company like Richmond Monroe. They're at West Branch, Missouri to review, to correct any issues. Joel Markovitz is a buddy of ours out of California, does collateral review. There's a company called CSC out of Dallas that will do collateral review and correct things. There's also a company called CJ Wilson out of California that will help you create documents and get things recorded for you. Realtors, you're going to need to use realtors to pull comps or to help you sell the property. Go to realtor.com, or we've got a referral network for you to tap into as well. Okay. You need forced place insurance. If the bar is paying for insurance on it, that's great. But if they don't pay, you're going to want to either get your own property insurance company to do forced place or to insure it through the servicing company, which will often have like a blanket policy that you do. But if you need to do it individually, Ross Diversified is good. National REI Group out of Kansas City is good. And then also US Risk is also good out of Dallas as well for you. Your realtors should also know of property preservation companies that go in and winterize it to turn the water off to avoid you having, pipes burst during the middle of the winter. And we've got, Baldwin Advisory Group has been a great company out there. Dickie Baldwin, who started the company about 6-7 years ago, done a great job. He's having a few health issues, but he's still got great vendors out there. So go to baldwinadvisorygroup.com. You can see a video of us walking through what he does and how to start ordering your BPOs and O&Es directly from them. Okay. Questions before we move on to what comes next, ladies and gentlemen? All right, everybody. So we've covered the basics of note investing. Hopefully you've taken some insight, learned a few things on what goes into becoming a note investor, what type of different things you can focus on, how to raise capital, the different exit strategies. There's a lot of moving parts to notes, just like there's a lot of moving parts to anything out there. But the great thing is you can do notes from wherever you live in the country. We've done notes when we were abroad and bought notes here. Okay. You don't have to be next door to the property to take advantage of what's going on. I mean, it's great if you can, but we've bought 95% of our deals outside of the state of Texas. And I have not visited 95% of those deals. I have visited 5%. Like we've flown to Florida, spent a week driving around looking at assets I owned, assets we were thinking about buying. Done the same thing in Michigan, done the same thing in Ohio. Stuff here in Texas, I'll drive it and take a look at for making an offer. I might even go up to Oklahoma if they're all around like Oklahoma City and stuff like that. But the best thing that you guys can do, though, if you find notes interesting, I think this is something that you want to follow through and perform on and start diving into to put your money to work passively or semi-passive, then what comes next is important for you to know. I mean, you're not going to learn everything about note investing in a 3-hour online class with me here on a Saturday. You're not going to learn everything about note investing by going and listening to every episode of the Note Closer Show or going to our YouTube channel and watching everything there. You're going to learn a lot. You're going to learn a whole lot more than most people teach. That is the truth. That's not me speaking. That's others speaking. Okay. But if you want to take this relationship to the next level, ladies and gentlemen, then here's some different opportunities for you. Okay. Our next thing that you really want to take a look at is our Note Buying for Dummies workshop. Going to notebuyingfordummies.com. This is a 3-day class, a Friday, Saturday, Sunday class that's designed to help you take it to the next level. All day on how to find deals on Friday. Saturday's all about funding. Sunday's all about the exit strategies, bringing deals together. And we mix in our marketing and tape evaluation along the way. We go through a ton of case studies to help you understand kind of what happened when a note was bought and worked your way through it. The 200-plus page manual, it's phenomenal for you. All right. Just to give you a bit of an idea, people have gone through our class. John and Veronica Gore closed on 20 notes that see a 22% ROI or greater. Cal Ewing's bought 12, actually bought 13 or 14 now. he's got one. It's going to be over $150,000 in profit. Philip Berdeur is 14 notes. He's out of Canada. Larry's bought 50 plus. Catherine Bell's bought 20 plus. Keith Holland's bought 4 notes with a 600% return on one of his deals. Okay. Paul Raleigh's bought some performance. Dimitri Armstrong's brought a note. It resulted in roughly about 20K profit. Sterling James, our newest coaching student, is seeing a 28% return or more on the one deal he bought in the last 90 days. Okay. I could go on and on. Actually, this is, if you go watch this case study, 28% ROI in a self-directed IRA, episode 943 of the podcast. That talks about how Sterling James bought the note, and we talk about it from start to finish for you. Now, if you'd love to come spend 3 full days online with me for 3 full days, it's via Zoom, just like we did here. It's April 18th, 19th, and 20th. That's what we have it tentatively set for. Steph just told me that's Easter weekend. All right. And I guess Mother's Day is like 2 weeks later, something like that, if I'm right. So we may have to bump it a week to the 25th through the 27th. Okay. Or we bump it to like the second week of May, if that case. The great thing about it is you don't have to wait till then to learn the note business. If you get signed up for note buying, the class, notebuyingfordummies.com, you'll get the replays of the October workshop and you can start learning there and then be able to jump in when we do the live class again. And if you can't make the live class, guess what? You'll get the replays to that as well if you can't make all 3 days. I know it's a lot of information, and I know the mind can only absorb what the ass can withstand, but I promise you 3 days with me is entertaining. It's mostly me. We might have a vendor or two jump on and spend an hour with us there. And then we're going to have Meryl Chandler from Get Fundable be on the Friday class, part of it. And then we'll probably have Aaron Young on Saturday or Sunday. And then if Dickie Baldwin is filling up too, we'll probably have him on to speak as well. The idea here, ladies and gentlemen, is that we're going to give you plenty of bonuses. We're going to give you the October replays. That's about a $300 value. We're going to actually do a 4-week implementation group coaching. If we have 20 or more students, we do that afterwards. We should have more than 20 to help you kind of implement more stuff along the way the next 4 weeks after you take the class. Lawful Associates gives away their entity secrets class for free. We're going to give you the wholesaling and calling banks master class included with that as well. We're going to also give you a 20 by 20 fine and fun video training series we put together. People really love that. You can bring your partner or spouse and attend the class at no additional cost. Just let us know their information and we'll send them the Zoom link to their email so they can attend and ask questions and be there too for you. And then we're always going to bring in a pool for you guys to take a look at the bid on. And no, we don't charge 20 grand, 30 grand on top of what you pay. We'll give you the pricing expert or help you with the pricing, make your offers to take the next level. So that's literally over $2,500, over $3,000 in values included along with that. And yours truly being able to learn from me, not somebody else, ask questions live during the 3 days. It's a lot of information. I get it, but it's designed to help you take your business to the next level. We usually do it from 9 to 5. Sometimes we have a heavier California or West Coast presence. We'll push to 10 a.m. Central to 6 p.m. Central so that people can attend a little bit earlier on the West Coast, folks, instead of being so early in the morning. But we're here to give you the nuts and bolts to help you take your business, help you learn A to Z, how to go out and walk away from our class to make your first offer. Usually like we did our in-person class was $14,997. Normally our virtual class has been $997 for you. We've decided to make an effort to drop it down for you to get more folks in, for you to take advantage of what's going on in the market. We know folks are struggling to pay for milk and eggs. So we've cut that price from $997 down to just $497. All right. And that includes you plus your spouse, the replays to the previous class, the access to the 3-day class, plus the replays of that class, a 200+ page manual, a tape free to bid offers on, and other bonuses for you. So if you go to notebuyingfordummies.com, click on the link. There's no discount code you need to see. It should automatically be at $497 for you. Take advantage and get signed up for that. We'd love to have you be a part of that. For those that register for this class, we'll be sending the replays out on this, the Note Weekend here. If you're signed up for the class, you can have the replays to the October class in your inbox as early as tomorrow. All right. So something to keep in mind for you guys. We'd like to get it out for you so you can start the learning and book a phone call with me at talkwithscottcarson.com to take your business to the next level. Okay. Now, if that's a little bit too expensive for you because the budget's a little tight, we understand that. We talked about our monthly membership, which is at $97 a month. Okay. Now, if you sign up for the monthly membership, you got to be signed up for 6 months. We don't let people just sign up for 1 month and cancel if you're gobbling all the good stuff. That's just not fair. But we're willing to finance the 3-day class across 6 months for you with $97 a month. But that's no umbrella. It's going to give you access to the virtual workshop, a ticket to a replay of our note camp, access to all our note weekend trainings, past access to our wholesaling class, our due diligence class, our calling banks class. All that's thrown in there, plus extra special vendor discounts to events like Magnify Your Wealth or GetFundable.com or other things that we have available for you guys as well out there with our broad network of vendors that we work with, discounts to a variety of things. So if you want to do that, that makes it cheap. I know we got some folks online that love that, like Albert. I know you're a WCN crew member, and it was friendly on your budget, which is great. You're going to be around for a while, and you get access to me. Book a phone call with me to answer your questions. Albert was working on an email. He needs some help. This isn't working. So we got on and looked at it. Like, oh, here's how you made the mistake. Here's how to fix that. Here's how to correct your LinkedIn. Plus, we do Monday morning coaching calls at noon on Monday for you guys each week to go through. We might be adjusting it a little bit, maybe a little bit in the middle of the week, a little bit more. I know Monday's busy for a lot of folks, so we might adjust that a little bit for you. But anyway, that's noteumbrella.com at $97 a month for you to take advantage of that to get the ball rolling. But this is required for 6 months. Cancel before 6 months, we're going to charge you the remaining amount of what you didn't pay. Okay. We do have one-on-one coaching. If this is something that you're thinking about, we are here to help you take your business to the next level. And one of the biggest things I've always been concerned of is when I sign up for coaching, I've spent hundreds of thousands of dollars on coaching, is I want to make sure I'm working with somebody who's actually in the business, not somebody reading from a manual, not some employee, but somebody who's actually doing the business. And that's what's so unique about my one-on-one coaching is you're working with me on a regular basis. We do 8 weeks of coaching calls. These are one-on-one Zoom calls with you and me truly, or you and your spouse and me. We do it in the morning, the afternoon, the evening, what works best for your schedule. We're going to give you a list of over 5,000 asset managers. We're going to give you introductions to our top 12 hedge fund managers to give you deals directly. We're going to help you with raising private capital, help you with the marketing side. You're going to have VIP access to me. After those 8 weeks of one-on-one coaching calls, we have you come in and spend 2 days in Austin with me one-on-one. And then after that, we do a 6-month follow-up call on Zoom just to help you along the way. But we will help you find your first deal. We'll help you fund your first deal. We'll help you hold your hand along the way as long as you follow what we teach. Now, if you're not going to, I had one guy years ago, we found this amazing deal. The house was worth 90. He could pick it up for 50. We're closed on 90 days. Oh, it's not a perfect deal. Like, yeah, it's a damn good deal. Oh, it's not perfect. Well, you're not. If you're looking for perfect deals, go do something else. You're just not a fit. But we're gonna help you find a deal. Like we helped Sterling with his one-on-one coaching find that deals in his IRA. He's making 28 to 38% in his first year. We helped Phil, John, all those people are coaching students. We've helped them take their business to the next level. And so many people ask me, well, Scott, if there's so many deals, why are you teaching? And do you make most of your money off of teaching or deal flow? No, we make the majority of our money off of deal flow. Yes, we make some money coaching, but the way we've always looked at coaching students is help people go from 6 months or taking a year to figure out to do it in 60 days with yours truly. And my coaching students become my family. They become the people that we share tapes with, that we co-bid on, that we work to help them out. And they get beat. They're my kids. I don't have kids, right? I got the four-legged kind. So they become the people when they have an issue or a deal. These are the people that we'll partner with. These are the people that we'll find. Hey, there's a deal in your backyard you may want to take a look at that nobody else will see. Okay. So we bring opportunities to the tables. We help our students close deals. And that's why our company's called We Close Notes, not We Talk Notes. Okay. Yes, it's a little bit of investment with our note coaching program. Normally it's $24,997, right? $25. We credit whatever you pay on the 3-day class towards that. We also have a paid in full discount that if you want to pay in full in 30 days, we'll drop it down to $20,000 even. Okay. We also have a third-party financing program because our class is so successful and our students do such a great job that you can actually finance that over a 24 to 36 month period. If you're making 40 grand a year or more, you've got a 620 FICO score or greater, and you're here in the United States. And if you're interested in finding more about that, which is pretty easy to find out if you qualify, just reach out to me. We'll send you the link for that. And they'll do and often what's great about that, there's no prepayment penalty on that. We had quite a few students sign up for that, take the financing option, and then they're saving their own money for deals, using somebody else's money to fund the deal, and there's no prepayment penalty. So when they close on a deal, they pay off their coaching, and they're rocking and rolling there, and they're getting coaching without without before their first payment is due in 45 days. So that's something to keep in mind for you. We've got a great coaching program. We provide that. We help you find the deals. No, we don't jack up the pricing on the tapes. We give them to you. Hey, here's exactly what they're at. Here's where you should make your bid. Nope, you should probably reduce it. Let's hold your hand through the due diligence process to make sure you're truly buying deals and not duds. All right. Are there any questions about that before we let you guys go this afternoon? It's been a pleasure to have you here. Like I said, third-party financing through ease, pretty easy to get qualified for. If you're interested in this, check it out, guys. There's so many opportunities available out there, residential, commercial side. You know, we've got some friends with some deep pockets to help finance some stuff too. If it's a good deal, we can really help you take your business to these next level for you. All right. Any questions, comments, concerns? It's been a great time having you here. Let's see, we just did this here. Let me go here. What I want to do is, like I said, if you're interested, guys, make sure you check out notebuyingfordummies.com. That's our 3-day class. That would be the logical step for most of you to get the ball rolling. If you have questions about the class or what's going on, or what do you think it'd be a good fit, or I have this much background, I want to do this, then book a call with me at talkwithscottcarson.com. That's talkwithscottcarson.com. I'm glad to answer any questions. I want to say thank you for joining me here for 3.5 hours on your Saturday. Hopefully you've got a fun day planned out ahead of you the rest of the weekend. And those that joined us live, Mike, Jerry, John, Albert, and those folks that popped in and out, we're glad to have you here. Hopefully we'll see you at the top here, ladies and gentlemen, and hope you take the next step and get signed up for our workshop here in just over a month. But otherwise, go out, take some action, buddy. Hopefully answer some questions so we can help see you at the top. Bye, everybody. Hey, note investors. So you want to dive into the world of note investing, but know how to get started, or you don't want to pay $30,000, $40,000, $50,000 for a one-on-one coaching program that just completely does not deliver the deals or the funding or the access that you need to take your note business to the next level. That's why we have our one-on-one coaching program. I'm Scott Carson. I've been buying notes for 20 years. I've helped thousands of investors buy their first note direct from banks, using either their own funds or other people's money to buy non-performing, reperforming, or performing notes, yielding them an above-average return. Now, what's involved with my one-on-one coaching program? It's unlike anybody else's, because guess what? You're working with yours truly, not some paid student, not looking at some recycled list of stuff. Now, what we do is differently than anybody else out there, and that's why we have such a huge success rate with our one-on-one coaching program. What's involved? Well, once you take in our 3-day class, our Note Buying for Dummies workshop, sign up for our coaching. You get 10 weeks of one-on-one coaching calls. These are on Zoom in the morning, the afternoon, the evening. What works best around your work schedule? We accommodate this to help you start looking at stuff. And during those 10 weeks, we focus on finding deals, making offers, getting your website and your social media stuff set up so that you are a lean, mean note buying machine. After spending 10 weeks of Zoom calls with yours truly, that's right, live, not somebody else, we'll spend 2 days one-on-one. And usually people come to Austin, Texas to hang out with us on a Thursday, Friday, or Saturday, Sunday. And those 2 days are focused on whatever you are still lacking and need the most amount of work on. Sometimes it's making offers. Like Larry came in, we made 50 offers that he got 20 approved in a weekend. Other people came in to raise capital. So we helped them find IRA investors to fund their deals so they're able to raise hundreds of thousands, if not millions of dollars for their note deals and other investing stuff. We're also going to give you a list of asset manager contacts for you guys to dive into. That's right. This will be either LinkedIn profiles, emails, phone numbers, names, all for you to start reaching out to people. No, you don't need to buy notes directly from me. We're going to show you how to go to banks and contact them directly. We're also going to make introductions to our top 12 hedge fund managers that send us deals on a weekly or monthly basis. That's right. You go straight to the front of the line. And guess what? There's no 10, 20, or 30,000 upcharge for the deal. You buy direct from the hedge funds because we make the introduction. That's why, why do we do this? Because we know, not we believe, we know there are more than enough deals to go around. And yes, we make most of our money from buying note deals for ourselves. Some people will say, oh, you're creating competition. No, because there's plenty to go around. All right. We're also going to give you a 1-year membership to our WCN membership for 1 year. That's $97 a month usually. That's going to allow for you to continue support, weekly coaching calls, along with access to our Basecamp group for other things, other tapes, other resources for our coaching students. We're going to help you with raising private capital, putting your pitch deck together, putting sample deals together, or either case studies that we've done, other students have done, or that you're doing, so that you help raise capital or help you find IRA investors in your local market or the markets you're looking to buy in. You're going to also basically, for you plus your partner, spouse, person you're going through this with, you're going to have VIP access to me. That's right. Whether you need to jump on a quick phone call, a text message, a quick Zoom call to go through tapes or notes that you're making offers on for us to review your bids, or to help answer a question when it comes to loss mitigation, foreclosure, bankruptcy, whatever it might be about a deal you're working through, get VIP access to me most of the time. Come on now, everybody. We're also going to do a 6-month follow-up day after you spent 2 days with me. 6 months later, if you want to, we can do a half day, a full day Zoom follow-up just to see where you're at, what are you dealing with, where you're looking to go. Because within 6 months, you should have already closed on several deals the way that we teach. It's because we will help you find your first deal and then some. We've had students who've closed on their first deal in 30 days. We've got others who've closed on 6 deals in their first 35 days. Other people have closed on 100 deals in their first year. We're here to help you because guess what, ladies and gentlemen? There is plenty of inventory out there. We're not going to focus on owner finance notes. We're going to focus on how to get people calling you with their deals, or how to get banks sending you lists on a regular basis that you can cherry pick and show you how to raise all the capital that you need. Our one-on-one coaching program is the most complete program out there. That's why you have such a high success rate. And it's cheaper than most of the others out there. And we also give you the biggest bang for the buck by helping you make the introductions, looking at the tapes, helping you bid if you are coachable. Now, not everybody's coachable. Not everybody can afford this, but what we can do is we can set up payment plans and different options for you. I encourage you to either book a phone call with me at talkwithscottcarson.com, and we can talk about it, see if you're a fit. Not everybody's a fit, and that's A-okay. But go to talkwithscottcarson.com, book a call on my schedule, and we'll gladly talk about our one-on-one note coaching program to see if you're a fit. One of the very requirements is we do require people to go through our 3-day class, but that whatever you've paid for that 3-day class is applied to the tuition for your one-on-one coaching. And we also have a third-party provider who's willing to finance this and carry financing for 2 to 3 years to help you pay it off. But we're going to work with you until you get your first deal closed. We want to help you make your money back in the first 6 months, if not sooner. So check us out. Pick up the phone. Give me a phone call. Talkwithscottcarson.com. That's talkwithscottcarson.com. Book a call, and let's see if you're fit to take your business next level. Sometimes all we need is just a hand up to take you to the next step, to show you the way. This is not a blow smoke up your tail, give you the crappy tapes left over, or upcharge you $10,000, $15,000, $20,000 per asset. No, we want you to buy direct, and we've always found if you can show a man how to fish, you'll feed him for a lifetime. So let's get started, you being a note investor for the rest of your investing lifetime.